guys, and welcome to this complete free training for traders, and the goal here is really simple. It is to take you from a struggling trader that is unprofitable to finally a profitable trader who makes money consistently. So whatever you've made zero profits for now, or you had a few wins but just can't seem to be consistent, this video is for you. And by the end of this video, I guarantee you that you will be a competent trader that knows what to look for in the market. Now, if you're new to this channel, you might be wondering who am I and why should you listen to me? Actually, only 2 years ago, I was a broke college student working in a pizza place for only $20 per hour. And in just 2 years, I went from being that to being a full-time trader, winning trading awards, traveling the world, and helping many other people like you do the exact same thing. Trading for me was all about freedom. I didn't want to rely on anyone on how much money am I gonna make, when I'm gonna wake up, clock in, clock out, when I'm gonna take my vacations. I just wanted to choose from what I love and do what I love without any external pressure. And over the time, I as well built my amazing community, and that didn't just happen by accident. It was because instead of flexing some Lamborghinis or nice things that I bought, I was always being transparent, keeping things real, giving free value, insights, and helped many other people understand trading by answering all the DMs and give the support people actually deserve instead of being ignored by any other mentors online. There is so much crap out there with those fake gurus promising you like a luxury lifestyle that just actually want to sell you some signals, take your money without providing any content or good value. And my goal to this video is to get you to your goals without any fake promises, any crap, any talking for nothing, and just strict value from A to Z on how you can follow my mechanical strategy without anything in return. And it doesn't need to be complicated because SMC is not as complicated as you might think. Now, this is a long and comprehensive video, so I don't want you to take it as any other videos on YouTube. I want you to focus and actually apply the concept that you're gonna learn. I want you to take it seriously because this will be the textbook on how you should trade. This is going to be everything you need to start trading, so don't forget to take notes because this video will allow you then to understand how to trade to live the life of your dreams. So save this video, take notes, and take it really seriously. In this video, I'm gonna give you a success roadmap about smart money concepts. What is the market structure, how to identify your points of interest, risk management, psychology, why 90% of the traders are failing, how to trade without risking your own capital and for a really small cost, and even much more. I've added timestamps so you can jump between topics and go at your own rhythm as well. And keep in mind that what you're about to see are individual videos taken from an extensive, longer program that I have. I didn't want to make this video super long, but I've selected the modules you need to progress faster and get everything you need. Now, if you want even more support, daily insights to be a profitable trader, I've put a completely free group with the exact blueprint that got me and multiple of other students funded and incredible results. You will get there my full strategy, daily insights, and much more that I can't mention it right here. So if you want to join, I'll leave the link in the caption of this video down below. But for now, let's dive in straight away into the free training video. So, are you ready? Let's go! Hey guys, and welcome to our step-by-step SMC trading program. So if you don't know what SMC means, it just means smart money concept, and this is the strategy that we use to trade with our mechanical edge that is really rule-based. So first of all, I just wanted to tell you congratulations that you are here. This means that you're really serious about learning trading, and you will see in this program we will go from the basics of trading. So even if you don't have any knowledge about trading, how it works, you will learn step by step everything you need to know before going into more advanced concepts, like for example market structure, the strategy, the psychology, etc. And if you're not a beginner in trading, I really recommend you to still go through the basics, because like that everyone in the community will have the same base, and that way you will not get lost if, for example, I already covered a concept in videos that you skipped. And actually guys, another thing is that for this program we have a trading psychology component that comes after the basics of forex, but before learning the actual strategy. And this is actually really important that you don't skip it, because a lot of people are neglecting trading psychology, but this is why I put it before actually the technical analysis, and I really recommend you to go through the videos before actually start to learn. Like that, you will be prepared for the mental challenges that trading can give you. So that's it, guys. I just want to tell you that if you have any questions while watching the course, I really recommend you to just write me down. And if you took the private mentorship program, don't forget you have as well the Slack access. That way you can contact me anytime you have any question. So that's it, guys. I really wish you good luck, and don't forget to ask questions if you have them, and see you soon. So welcome into this first video of our course. So in this video, we're gonna see what is exactly forex trading. So we're gonna just talk about each word and try to understand what it means basically. So forex basically means the foreign exchange market. This means that in trading forex, we are exchanging currencies, and you already all know multiple currencies. So for example, your country. In my example, I live in Canada, so I pay my things with the Canadian dollar, right? If for example you live in France, you will pay with the euro. If for example you live in Japan, you will pay with Japanese yens. And when we trade currencies, we actually exchange one of the currency into another currency to make a certain profit. So for example, if I want to go in France, right, and I have Canadian dollars, I will need to exchange my Canadian dollars into euros, because in France I cannot pay with Canadian dollars. It's not their currency, right? So I will exchange my Canadian dollars and I will just pay with their euros. But to exchange these Canadian dollars, I will need to go to an exchange booth. So if for example I exchange 1 Canadian dollar, I will receive 0.67 euros. So basically this is the value of my Canadian dollar into euros. But then, for example, I go in France, I pay with my euros, etc., and then I come back to Canada and I still have some euros left. I can exchange them back into Canadian dollars. And this is basically the fluctuation of the price. If, for example, price a little bit pushed up since my travel times, and then now instead of 1 Canadian dollars, it's worth more. So, for example, as you can see, it's now worth 0.69. What will happen? For example, if I put 0.69 here, you will see I would have made a 3 cents profit just by actually holding the currency. So I exchanged it at point A, I had this amount of money, and then I exchanged it back at point B, and then I received more money back. And this is exactly just how trading forex works. So exactly right here, this is EuroCAD. So this is the euro dollars against the Canadian dollar, exactly the example we did. So for example, if I bought some euros at this point right here, and then right here I was traveling in Europe, whatever, and then I came back to Canada at this point right here, and I exchanged my money back right here. So I buy here and I sell here. Basically, you see, I would have made a profit because price pushed up. So if, for example, right here, I bought 10 euros, right, and then I exchanged them back right here into Canadian dollars, my 10 euros, like you see the graph pushed up. So if I exchange it back into Canadian dollars, I will actually receive more euros. So as you can see, technically, if I take and measure the price, I will receive basically 1.69% more. So if I just exchange it right here in the calculator, so my 10 euros will have been transformed into 16 euros. So this is how trading works, by buying currencies, selling them, and of course you can as well do the opposite thing. So you can as well sell the currencies right here and buying it right here while doing a profit too. But this is, we're gonna see it a little bit later. But yeah, this is exactly how it works. We have currencies, we have multiple currency pairs, and we exchange them to make a profit. profit or sometimes a loss. So now that we know that actually trading forex, it's trading currencies, you will tell me, okay, but I don't have time to go every single time to an exchange booth, exchange my currency, hold it in my pocket, and then go to the exchange booth and change it again, right? This is not how it works, because when we trade forex, we actually trade everything on our computers or on the cell phone, because we have dedicated brokerage that are basically brokers that are doing this job of exchange booths for us. So we put money into some brokers and we have dedicated platforms and softwares that we can just click on buy or sell exactly right here, and that way it will instantly buy the amount that you want without going to the exchange booth every single time. And then if you want to sell, you just click on sell and it will just sell. And another interesting fact about the forex market is that it is the largest and the most liquid market in the world, because it has a daily transactional volume of $6 trillion. Not millions, trillions, guys. It's huge. So it's really the largest, and there is a lot of opportunities while trading forex. You can have multiple combinations of pairs, multiple charts. So it's a really nice market to learn how to trade. So that's it, guys. That's the basic things about the forex market. So what we learned basically is that we exchange currencies. There is some brokers and platforms that we use to exchange those currencies. We will learn how to use them in the future, and we are actually making profits by buying or selling those currencies and doing the opposite later on in a little bit later to make a profit or a loss. So that's really easy. That's just pretty much it. We will learn then strategies to optimize those results, to look for entries, looking for exits, so that way you will know how to enter, when to enter, at which level, when to buy, when to sell. And this is exactly what we're doing, and this is exactly how we're making money. Hey guys, so today we're gonna talk about the bid price line, the ask price line, and the spreads. And this video will be a little bit special because we're gonna watch a video basically that I already did on YouTube, and after that we're just gonna consolidate and solidify the knowledge that we saw in the video. That way, as I already explained it pretty well and the video is already really good, we're just gonna watch it first and then I'm gonna re-explain it and show with some examples so you can understand it even better. So first of all, the video right here is from a series that I did with this YouTube channel that is a simulated trading company that is called Funded Next, and we did like a little videos about trading for beginners. So this is one of the episodes of this video, so of this series basically. So we're just gonna watch it, and I'm gonna stop it just before we start to talk about stop losses and take profits, because it's gonna be explained in the next video basically. So right now let's just watch this video at first, and then I'm gonna go on the real chart and show you with real examples basically what do I mean in this video. Okay, so let's watch it at first. Hey guys, so are you ready to dive into the world of forex once again? If yes, in today's episode we're gonna talk about the ask price, the bid price, the spreads, the take profits, and the stop losses. So yeah, like I'm gonna talk about the take profit and the stop losses too, but this will be in the next video for this course, as we're simplifying it step by step. I want you to really understand each concept before passing to the next one. So yeah, that's why we're just gonna focus on this tutorial about the spreads, the ask price, and the bid price line. Let's start now. Imagine that you have an orange that you want to sell, and then there is a person who comes to you that owns a business with oranges and offers you $1.50 for your orange, and then you agree to sell your orange at his bid price of $1.50. But this person who just bought you the orange, as he is a businessman, he wants to sell the orange at a higher price to make some profit, right? So he's gonna find some someone who wants to enjoy the orange, and he's gonna ask them to buy the orange for $1.75. So if the person who wants to eat the orange buys it at $1.75, the businessman makes 25 cents of profit. As you can see right here, there is a businessman in the middle that is facilitating the trade of oranges by arranging buyers and sellers and making a profit in between. That is exactly what brokers do in forex trading. They facilitate the trade of currencies by providing platform support and make a profit in between. However, in forex trading, you are able to buy and to sell currencies, unlike here that you were only able to sell your orange. When you sell a currency pair, you're actually selling it at the bid price that is set by the broker, similar to the orange that you sold for $1.50. And when you're buying the currency, you're actually buying it at the asked price set by the broker, similar to the person who bought the orange for $1.75. The broker profits from the difference between these prices, and this is known as spreads. So in trading terms, you and the final person who bought the orange are the traders, and the businessman is the broker. As you can see right here, there is parallel lines moving on the screen. So the line that is on top is the ask price line, and the line that is in the bottom is the bid price line. And the ask price line will be always on top of the bid price line. And the gap between these two lines is known as the spread. So if you want to sell your currency pair, you just click here and your trade will be open at the bid price line. And in the opposite, if you want to buy, you just click here and your trade will be open at the ask price line. So if you want to close a selling position, you will actually close it at the asked price, and if you want to close a buying position, you will close it at the bid price. Now let's take a Okay, so that's pretty much it. You have pretty much now a basic understanding of the bid price line, the ask price line, and the spreads. So I'm just gonna re-explain it really simply with some graphic designs that we're just gonna do on Tradingview right now. Okay, so basically we're just gonna go right here on MetaTrader 5 because this is the example that we used in the other video. And basically, as you can see right here, we have on the right the prices of the certain currency that we're actually trading. In this case, let me go on a really basic currency. So let's go on Euro USD. So this is Euro USD, okay? And right now, actually, you see that the price of the euro compared to the US dollar is 1.04452. Okay, this is the actual price compared to the US dollar. So it's what the euro is worth against the US dollar, basically. And we're gonna talk about this specific number a little bit later on. But just for now, memorize the fact that this is moving in function on how the market is performing. So in this case, as you can see, I only have one line exactly right here, and this is actually the bid price line because this is actually where the market is at the moment. So it's pretty much similar to, for example, the initial person that wants to sell the orange to the businessman. So for example, I have this beautiful orange, as you can see right here, and if I have this orange and I want to sell it to you, I'm gonna sell it, for example, for $1 and you buy it at $1. So this is the price that my orange is worth in my initial hands, okay? And then, for example, someone else buys the orange and then he wants to sell back to someone else. So for example, now the orange is transferred to you and you want to sell it to someone else. You need to make a certain profit, right? So you will not sell this orange at the same price that you bought it from me, right? You're gonna sell it at a higher price to make a certain profit in between. And this is actually the asked price line. Right here, this asked price line doesn't appear. So for the asked price line to appear, you actually need to click right on the chart, and then you go right here on properties, and then you see you have show ask price line and you click on it, and basically you will see right here another red little line will appear. And as you can see right here, this is let's go on a lower time frame. You will see that there is two lines now. Let me go on another pair just so you can see it better. Okay, so you see you have this line right here and you have this line on top. Even if the price at the moment is actually right here, you see this candle is just moving at this certain level exactly right here, the asked price is higher because, again, if you want to buy this currency, the broker needs to make a certain profit. This is why he will not sell the currency at the actual price. They will sell it for a higher price that is actually in the market. So for example, if I want to buy this pair, so for example, I want to buy AD NZD, and you see right here, the price is actually at this level. But if I click on buy, what is gonna happen? Actually, what's gonna happen is that my entry will be placed at a level higher. It will place right here. Even if the price is right here, my entry will be still placed a little bit on top. Exactly the same way if, for example, I bought an orange in a store instead of buying it to the farmer. You know, there's gonna be a certain margin where the price will not be exactly the same. So for example, let me just show it to you. Let me just do something quickly right here. Let's buy a little bit. Let's buy 0.10 lots just to see how it works. So for example, I click right here and I click on buy. See right here what's gonna happen. This is where the price is, this is where the asked price is. If I click on buy, I accept this, bam, you will see what's gonna happen. So as you can see right here, the entry got entered exactly right here. So I was entered in a loss straight away. Even if, for example, I bought at this level, as my entry was targeted at the ask price line, we will always start in a loss, basically, if you want to buy, because to make a certain profit, I need to actually push through where I bought it. So for example, if I sell this orange to you and you buy it from me and then you sell it to someone else, so for the person who you sold your orange to, for having basically the same amount that you bought it for, it needs to be sold even higher. It's actually always a game of you buy it here, you need to sell it higher to make a profit. You buy it here, you need to sell it higher, because actually when you buy the price actually from someone else that is not the original source, you will basically lose money. It's just how it is, you know. Instead of buying milk from the farmer for $1, you will buy it at the store for $2. You lost $1 in between. So basically, to make the same amount, the price needs to push up to compensate for the fact that you bought it in a loss, right? So this is exactly right here what's going on. You see right here, price is just pushing down and actually I'm in negative. If, for example, price pushes up and then starts to be in this area, then I would be in profit. But for now, even if price never went to this level, I bought it at that level. So this is how it works for the ask price line. Then, for example, okay, if I do the complete opposite, so if I want to sell, okay, it would be however different, okay, because if, for example, I want to sell, now I want to sell it at the higher price possible. So instead of getting in the market at the ask price line that is basically higher, I will get in the bid price line. So let me go on another pair. So for example, right here, so as you can see what's gonna happen if I want to sell now. If I sell, look where this selling position happened. It happened exactly at the market price, exactly at the market price. This is why selling, basically, when you sell, they don't want you to be in profit, because basically if you want to sell and then, for example, they open the position right here on top, you will be basically in profit if the price is here but they opened your profit here. So for example, let me just close this again. So for example, you have two levels, right? You have the chart pushing up like this, and then you want to buy. You want to buy it the low possible, as low as possible, right? So for example, if you open a position right here instead of right here, and then price just pushes up, from this point you will have made more profit than if you would buy in from this point. So for example, if if this is $1 and this is $2, you will make more profits if you buy it at $1 than if you buy it at $2 than if you want to sell it. But if you do the exact opposite, so if you want to sell it, basically it's the opposite that is gonna happen. So if now price is pushing down, you want to buy it as high as possible, because for example, if you buy it at this level right here, not buy, I'm sorry. So if you want to sell it at the highest price possible, because for example, right here, this line, imagine this is for example, you want to sell it right here from $3. My God, my 3 is ugly. Okay, so for example, right here, you sell it for $3, but if you sell it a little bit above right here, you will actually sell it for $4, right? And if you sell it for $4, that's better for you than if you sold it for $3. So this is the complete opposite. The broker don't want you to make money. It actually wants itself to make money. So for example, if it allows you to sell the price higher, it actually doesn't make any sense. If, for example, you're here, the price is actually at this level right here at the number 3, you will sell it for $3. You will not sell it at the ask price line for $4, if you understand what I mean. Because again, it's better for you to sell it at the $4, but it's not better for the broker. And the broker is not your friend. It's actually want to make money on your back, right? So this is why when you sell, you open the position right here, but when you buy, you open a position right here. So that's pretty much it. And the difference basically between these lines, so if I go right here, the difference between these two lines exactly right here, this is what we call the spreads. So as you can see right here, you have a little number right here, you see. If I do this, I extend, you'll see we have this called spreads. And this number right here is actually the distance between the ask price line and the bid price line. And what you want to do is to have this number right here as small as possible. Like that, you will not get penalized in any way. So for example, you see right here, Euro USD is actually pretty much between 0 and 2 spreads. This means that when you buy or sell, no matter what, you're gonna buy it at the actual market price. More you have spreads, so for example right here, if you see this position, you see there is a big gap, so there's a lot of spreads. So basically, when you buying or you're selling, you're actually penalized. And now you will tell me, okay, but if, for example, I want to sell, right? I want to sell and I sell it at this level exactly right here. I will not get penalized, but actually you still will get penalized. And why? It's really simple. It's because when you sell, fine, you will get your price at the right price. So for example, you will get it right here at this $3 instead of $4, right? But then if you want to buy, when you sell, right, you actually are selling to buy at a better price. This is how trading works. It's like you're trading, right? You're exchanging things. So for example, I want to sell this, okay? Because I, for example, got already an object and I want now to sell this, right? If I sell it to someone, right, and if I sell this to someone, okay, to make a certain profit, after that, for example, I want to buy the same object but at a better price. Because again, if I sell it for example $3, but then price right here pushes down and now it's, instead of being $3, it's now $2, and I buy it again, I will have made a profit because I sold it for $3 and I bought it back for $2. Make sense? So in this case, for example, if I want to sell and then buy it back again at a better price, the broker don't want you to do that. So again, when you sell, when you're gonna buy back, it's gonna be bought a little bit higher. So for example, even if the value of this, when I sold for you, it was $3 and now it's worth $2, but then the market, okay, is right here, it's worth $2, but actually the broker doesn't want you to have it at the actual price. It will make you sell it for $2.50, for example. So instead of having $2, you still sold it. So instead of having $2, when you buy it back, you will buy it back at a bigger price. So for example, same thing. If for example, right here, I want to sell. Okay, so for example, right here, I don't know, I want to sell and I sell right here. When I'm gonna buy, you see, I'm still in negative because when I'm gonna buy actually at the asked price line. I'm not gonna buy right here. I'm gonna buy back at this line right here. So if I close the position, you see, I bought it right here because again, the broker don't want to make profit. This is why it's super important to have as little spreads as possible. That way, when you buy or you sell, you're not penalized at all on where you actually are closing or opening your positions. Okay, so now let's talk about the take profit and the stop losses. So it's gonna be on the same video exactly right here. We're just gonna watch it again and then I'm gonna re-explain it in more details like we did for the spreads, the bid price and the ask price. So let's go back right here and talk about the stop losses and the take profit. So let's start it from here. Price. Now let's take a look at the stop losses and the take profits that are essential tools to be managing your risk and profits. The stop loss is a predefined level where your trade will get closed automatically if, for example, the market goes against you. It's like a safety net to limit your risk and preventing further losses. And contrary to the stop loss, the take profit is actually a predefined level where your trade will get closed as well automatically in case the market moves in your favor. That way it will lock in your profits. These tools help you manage risk and ensures that you don't have to monitor the market constantly. By setting up your stop loss and your take profit, you can control how much you're willing to risk and how much you're willing to lose on a trade, and as well how much you're aiming to gain. So that's it, guys. So everything we learned today. So it's really the most important concept that you can have in trading. It's actually so important because instead of, for example, investing on the long term, what we have in trading is actually more short-term trading. So for example, long-term might be years, but in trading, we usually hold in positions for like from a few minutes to a few hours, sometimes days. But for my strategy, I'm not usually going on weeks or years, you know. But even if you were trading for weeks or years or whatever, it's not the same thing as investing when you open a position and then, for example, the chart moves and you close in profit or loss manually. In trading, we have what we call a stop loss and a take profit. So like I said in the video, a stop loss is basically a level where the price will get closed automatically if, for example, the trade doesn't go in your favor. So for example, okay, we have this graph exactly right here, this chart exactly right here, and I want to open a buy position, for example, at this level exactly right here. So I buy exactly at this level. Let me put it in green, okay, when price is returning right here. So I'm buying it right here, and as I'm buying, I'm expecting this to push up. Right? This is what I expect. But imagine, as we all know, probabilities is what dictate the market, basically. So we never know at 100% if it's gonna work or not. We have probabilities like win rates. That's why, for example, there is a certain percentage of probability that the market doesn't go in your favor. And you don't want to lose all your capital if this happens. This is why we actually have a predefined level that we set every single time we enter a trade to get exited straight away if, for example, the market reaches that level. So for example, okay, let me change this color to white. And for example, right here, I place this line, okay, and imagine this is my stop loss. So basically, if, for example, market decides that it doesn't want to go in my favor and it wants to just push down, so for example, it pushes down right here, right here, right here, right here, when it reaches this level exactly right here, the open position that I got myself in right here will get closed automatically in a loss, of course, because again, this is the level where we are protecting ourselves from further losses, because again, market can go even down, right? It can go from here. So instead of, for example, of losing $10, you will lose like hundreds of dollars if you don't have a stop loss. That's why it's a predefined level that is a super important level to have. That way you will not get out at a big level where you lost all your capital. Because, for example, okay, if your stop loss is right here and this is worth $10, okay, the market more it pushes down, so for example this is minus $10, the more market pushes down, this is another $10 you lost, this is another $10 you lost, another one, right, until your account reaches zero. And again, you don't want that. You want to control your risk that you're putting in the market, right? So for example, this is why we're gonna have a predefined level every single time we enter trade, when no matter what happens, you will get kicked out and you pass to the next level. And now you will tell me, okay, but that doesn't make sense. For example, we all know that the market will move right here and then over another period of time it will just come back up and push up, right? But the fact is that you don't know. Like, yes, usually, you know, if you see a random chart right here and you see that if you opened a buying position right here, market pushed down before reversing to the upside, right? Yes, this happens, but what if you opened a buying position right here and the market never reversed on your side? You will lose all your capital. So basically, you cannot tell yourself, oh, I'm gonna enter without a stop loss anyway, even if I go in drawdown, so I go negative. So drawdown basically means I'm going in negative balance. Well, it's not gonna be good for you on the long term, because one bad decision, one trade that you hold too long and your account is ciao bye. You don't have an account anymore, because yes, it might reverse on you, but this is a really bad habit to have, because you never know if it will indeed come back to the upside or never come back to the upside. So you see, for example, yes, right here, if you bought it, you would eventually be in profit, but if you bought right here, you would just be in a really bad loss, and you don't know if one day it will come back to this level again. So this is why we always have a stop loss in place. And the take profit, basically it's exactly the same thing, but for your profits. So for example, if you enter a trade exactly right here with your stop loss right here, you need as well an automatic level where your price can push you out in a win. Why? You will tell me again, because it's really important to secure your wins, secure your profit. Because if you don't do that, okay, price might come to this level and then you, for example, enter right here, and now price is now at $10 profit. So now you are actually up $10, right? And then if you don't secure your profit, nothing tells you that price will continue to push up. It will maybe just continue to reverse and push down. And instead of having $10 in your account, you will end up with a loss. So that's why take profit is really important too. And this is an automatic level as well, where the price will kick you out in profit, basically. And we want that too, because like I said, you want to secure your profits as much as possible. Of course, we have exactly the strategy to set up our take profit, our stop loss, our entry that we're going to see, but it's really important to understand that both of them are really important and you need them. And as well, this is automatic. So for example, when you open the trade, so for example, I open the trade at this level, this is my stop loss, this is my take profit. Even if I'm not looking at the chart, even if I'm not on the computer, even if I'm not like looking on my phone, it will be all done by the algorithm. It will all be done by the broker. It's automatic. So you don't need to be constantly looking at the chart to exit trades and control your risk. So this is why take profits and stop losses are really, really important. Basically, as well, if you want to sell, it's exactly the same thing. However, your take profit will be in the bottom right here, and your stop loss will be on the top, because again, when you're selling, you expect price to push down. So if it pushes up and you sold it right here, when you buy it back, you're gonna buy it back at a bigger price. So actually you sold it for a smaller and you bought it at a bigger price, so you as well had a loss. So now that we know all the basic information, let's talk about actually our strategy finally. So what is exactly smart money concepts? So in this quick video, I'm gonna just explain really the basics of what do we use in smart money concepts, where does it come from, and why do we trade smart money concepts. So basically in trading, all strategies can work. This is the first thing I want to tell to everyone. No matter which strategy you're picking, it can work, but you need to learn it really clearly, and more the strategy have a precise rule-based set, so more it has a precise edge and a rule-based strategy, more the strategy will be strong and easy for you to use. And the problem in most of the traditional strategies is that, like we saw with the trend lines, like with the trend lines, support, resistance, etc., it can be really subjective. So depending on how do you see the market, your experience and things like that, you will not see the market as someone else. So it's really hard to have this really mechanical and rule-based approach while trading trend line, resistance, support and things like that, because it's really subjective. But smart money concepts, this strategy is based on supply and demand, so basically how the market is working. And as it's based on supply and demand, we are having actually a really more mechanical and rule-based set. So smart money concept, or SMC, this is what we use, is basically focusing on seeing institutional points of interests that we call POIs that we expect price to come back into before pushing and do a reaction. And with smart money concepts, we as well seek with a confirmation on a lower time frame. Like we saw inside of a bigger time frame, there is multiple candlesticks on lower time frames in one single higher candlestick, one candle. So basically we're seeking for lower time frame confirmation when price will come back into an interesting zone for us before continuing the direction. And basically in smart money concept as well, we will see that the market is leaving institutional footprints behind us. So behind, not us, but behind the market in general. So as you can see right here, we're pushing up and we're leaving gaps. As you can see, we're leaving colors of the opposite, candlesticks of the opposite color. We're leaving we're sweeping the highs right here before pushing down. So we're actually analyzing the patterns that the institutions and the big banks, etc., are trading and leaving behind them, so we can follow their movement as well. And as well with SMC trading, we're actually having way of a better rule-based strategy. So for example, everyone will see this white candle and consider that this is a valid point of interest. We'll talk later about how to identify them, but for everyone, this candle is white. No matter where you are, no matter what you're looking at, this candle on Euro USD at this timestamp is white. So this is a valid POI. It's not like, oh, but I consider my trend line like this, but someone else consider it like this. You know, it's not the same, you know, but this is the same for everyone. If you see this high being broken exactly right here and creating a new high, it's the same for everyone. Same thing, if you see that right here you have a gap right here, the same gap will appear on everyone's chart. This is why with SMC trading is really more easy to set rules and having this mechanical edge in the market than with some retail patterns that is really more subjective and really more dependent on how do you see the market. And basically in smart money concepts, we'll use basically 4 major things. We'll use the break of structures that we're gonna see later on. We're gonna use the fair value gaps, that are the gaps that I showed you previously in the market. We'll use the point of interests, the things that I showed you previously as well with this white candle right here, so POIs or points of interest. And we will use as well the Fibonacci retracement to calculate the retracements. And the last thing, we will use the liquidity and inducement. And basically for these 5 major concepts that we use, we're gonna analyze the market with those 5 same concepts every single time, and everyone will have the exact same rule and set of rules while trading. Like that, we will all see the same market the same way, and then we can discuss in the community what's going on, and for example what is the market's doing and things like this, instead of just someone sending a trend line like this and someone sending a trend line like this, and then they're just kind of fighting each other who has the best trend line. Because in trading, on SMC trading, everything is really mechanical and everyone sees the market the same way according to the strategy. So this is why we are specifically trading smart money concepts, because it's way more rule based, and as well we're leaving and following institutions, so how they are trading, and we're following their footprints in the market, and we are basically trading to follow them. And as we are trading to follow them, everyone sees the market the same way as well, because everything is really rule based. So SMC trading, in what it is just smart money concept with following institutions when we trade. Some people will say that's not true or whatever, but it is the goal of smart money concepts. It's to follow the big banks and the big institutions when you trade and make your strategy as mechanical as possible. And we're gonna see later on how to do so. So guys, let's go today over how to set up Tradingview. So we already talked about download the Tradingview, but that we need it for analyzing the charts, for the indicators, and like for the all the tools that Tradingview provides you. We need it to analyze the chart. Like we saw, Tradingview is to analyze the chart, and then we have MetaTrader 5 or 4, whatever, for entering your positions with your broker or your prop firm. And we're going to talk as well later on about Trade Locker. That is as well another platform that mixes kind of Tradingview and MT5 together. That is a newer version of technically MT5. It's not the same company, but it just looks better. And Tradingview is integrated in Trade Locker. So basically it's like the newest version to enter in trades in, and it's way better. But first today, let's talk about Tradingview, how to set up Tradingview and how it works. We're going to go over all the functionalities of Tradingview, and you will be ready to basically use it. So first things first, you need to download Tradingview if you still didn't download it. So basically you just go on Google or whatever your software is, and you write Tradingview. You click on Tradingview exactly right here, and basically you have 2 versions. Basically you have the version that you can directly see the charts on your navigator, but I really recommend you to download Tradingview and have it as an app, because you can basically just, you know, see the chart directly on Tradingview in your navigator. Like for example, Euro USD, I can open the chart of Euro USD directly on my navigator. As you can see, it's exactly the same thing, but this just is less convenient than just having the app Tradingview, and the navigator is as well. It's pretty much the same thing, but just having the app downloaded, it's always better. It's easier to access and it just lags less. But if you don't have the app, you just go on Tradingview exactly right here. You go on more and downloads, and basically when you click on download, you will be able to download for Windows. I don't know why it's so unzoomed, by the way, but yeah, you will be able to download for Windows, Mac, or Linux if you have Linux. So yeah, you basically download it, you create an account, really important, and then you're ready to go. Basically, Tradingview as well have multiple subscriptions. We're gonna talk about the subscriptions later on, but for now, as you're just a beginner, you don't need a subscription for the first part of the course. When we're gonna talk about backtesting and testing the strategy, you might need a subscription, but again, it depends of your needs. For now, I don't recommend for beginners to take a subscription, and as well, they will propose you to, for example, when you create a new account, they will propose you to give like 30 days try, like a free trial of the subscription. I don't recommend you to take it right now, because later on we're going to talk about a subject that is backtesting, and if you like, you will need the subscription to backtest if you want to do it directly on Tradingview. So the time that you go through all the courses, like sections and things like that, your 30 days will be already over, and you will not have been using your subscription basically, because for the basic needs you don't need it. So I don't recommend to take the subscription right now. If you want to take the subscription, it will be later on. And ignore their 30 days free trial for now, it's not necessary. So when you're gonna arrive at Tradingview, your Tradingview will be different than mine, because basically mine is already set up. So I'm gonna try to just remove everything and put it as it was. It might be still a little bit different, but it's pretty much the same thing. So first of all, you have the chart, right? This is the biggest thing that you have. You have the chart. And basically the basic chart colors are red and green. So red for the bearish candlesticks and green for the bullish candlesticks. And I recommend you to change your chart colors from these colors to another color, because basically red and green will affect too much your psychology. So again, the next module will be about psychology, and what people don't realize in trading, what makes you from a profitable trader from an unprofitable trader, it's your psychology. You can really be really good at technical analysis and analyzing charts, but if you have a bad psychology, you will not be profitable. And basically changing the chart colors help you having a better psychology. And why? It's because of the reason that that green and red is often associated to good and bad, basically. So we already know that, for example, a traffic light, when you see green, you go, and when you see red, you stop, right? So when you see that your chart is green and red, it will just to affect too much your psychology. So if, for example, you see that your trade is going in negative and you see a lot of red candlesticks like this, you will just think, oh no, this is bad, I need to close my trades, I need to close my positions, and it will just scare you. And as well, on the opposite, if you're gonna see green candlesticks and same thing, you are in profit, you might want to close your profit too early because you see green, you see like gold, that's good, we need to secure that, and it's just gonna mess up too much your psychology. So by changing the chart colors, it will not be as important than if it's red and green. Some people might disagree with me and tell me that it doesn't matter, but when it comes to trading psychology, all the tricks that you can do to help you with your trading psychology, even if it helps just a little bit, it's better than nothing. So again, like if I see, for example, if I open a selling positions, for example, right here, right, and then I see that my chart, instead of pushing down, it's just pushing up right here, and it just green, so it's telling me like, oh yeah, I need to close it because it's just going to continue to be green and push up, and then it reverses on us. So basically, if this candle is another color, I will not be having the same issue with the psychology. Same thing, for example, if I open a buy position, I don't know, somewhere around right here, right, with my stop loss, for example, like that, whatever, and then I see all the like red candles, all the red candles coming closer to my stop loss, this will really be scary, right? But if I see a lot of white candles, I don't care that the candles are white, it doesn't mean anything. But if you see a lot of red numbers, red candles, this is just saying you, oh my god, this is too crazy, I need to close this trade, I will lose all my money. Maybe I'm overreacting, but this is really helping a lot of people, and this is why you should close your not close, but change your chart colors. So how to do so? Okay, you gonna click right on your mouse on Tradingview, and you will have a lot of options. We will just start with the settings right here. So when you go in the settings, you have the symbol, that is the first setting exactly right here, and you have body, borders, and wicks. So usually it will be green and red. I personally have blue as my bullish candlesticks exactly right here, and white as my bearish candlesticks exactly right here. It's just the basic colors right here, blue, and the basic white right here on top. So now it will look something like this. So now you know I don't have the same psychology impact. Then of course you can change your time zone if it's not automatic. Like I said, mine is New York time zone, so UTC -5. And then we can as well go in status line. And basically right here, you can put some things on the charts, remove some things from the charts. It's not really important basically, but I usually right here, this is basically everything that is going on top. So let me just put everything so you can see how it looks like right here. So first of all, the logo is the logo of the currency. If you don't need it, you can remove it. I think it's pretty and it doesn't occupy a lot of space, so I keep it. The title is really important. This is really important because the title is basically naming your currency right here on top. If you don't have the title, you don't know which currency you're trading or which symbol you're trading basically. So the title is really important. The open market status, this is as well important to see if right now the market is open or closed. So right now you see it's green, so it means that the market is open. Chart values right here, honestly, this doesn't make any value for you. It's just not important, and it takes too much space on top right. So honestly, remove it. Bar changes value, again, not important. It doesn't, I don't even know honestly what it means. It's just what the market is doing, but not important. Volume. Right here, the volume, honestly, I don't know what is showing, but I removed it because it doesn't help us anyway. And last day change value, the number right here, same thing, it's not important because we don't use it in the strategy. For the background, it's just the background of this symbol exactly right here. You can keep it if you want. You see it's a bit darker right here. So, you know, when you have candlesticks, I mean, you can keep it, you know, now it's completely dark. So you see, I can see it pretty well. Or remove it if you don't need it, but basically this is all your own preferences. I basically don't really mind. Mine is in the middle right here. Skeleton lines, now right here, to be honest, you can just copy paste what I have. Honestly, this is not something that we use, and you can remove anything. It's right here basically. It's showing everything right here. Basically, you know, you can keep it. This is important. However, countdown to bar close, you need to keep it open because this is showing you how much time you have left before this candlestick closes on the time frame that you're trading. So in this case, in 2 minutes, this candlestick will close and a new one will open. So this, you need it. Anything else, to be honest, it's not really important. So you can just keep it like this. And same thing right here, leave this open because right here we'll have the date, and then it's always nice. Mine is in the 24-hour set. If you want the 12 hours, you see right here it will be PM, AM. Mine is in the 24 because it's how it is in Quebec. But yeah, you can change it if you don't like it. The Canva right here, this is the background. So my background is just this basic color. Again, you can customize your chart colors, your backgrounds as much as you want. In my case, this is what looks the best with my chart colors. Same thing right here, you can just customize pretty much everything. The crosshair as well. Mine is gray. As you can see, it's the lines. If I put a line, it will be a line. If I put dotted line, it would be a dotted line. Mine is just the dashed line. I still consider it's important to have a crosshair. The line, I don't really like it because it's too like full, but the dash line is good. This is just a preference, but yeah, the crosshair needs to be there. If you don't have a crosshair, you will not be able to see your lines, and it's just not good. So mine is basically right here, and it's the smallest possible, but I still need to be able to see my crosshair at least a little bit so I can see my lines straight, and it's just better to analyze basically. The watermark is to having your pair in the background, you see. But to be honest, I don't like it because it's too messy. It looks not good on the chart. I like my chart to be as clean as possible, so you can just remove it. Anything else you can play with it, but to be honest, you can just copy paste my settings. So for the buys and sell buttons, basically this is what you're gonna see on top left right here. So basically, if you will remove the buy and sell buttons. As we don't really use Tradingview to enter trades, but only for the analysis, you can remove it because that way it's just cleaner. If you will connect a broker to Tradingview, because it's possible to directly connect a broker to Tradingview depending on the brokers that you use, you can keep them. But usually we're gonna place a lot of limits, and you can just directly do it exactly right here, you know, with this little plus button. So you can keep it, remove it if you want. It's your wish, but I usually don't have it put up because it's not really important right here. And if not, instant order placement right here is basically if you click buy or sell, you will be able to place an order like this without confirmation. Honestly, it's always better to have a confirmation, so I don't usually consider instant orders because we again don't really trade with them. So again, you can remove it. This is execution sounds for entering trades. You can have it if you want, you can remove it if you don't want. For the notifications, it's all events if you need, because sometimes we're gonna have alerts. So yeah, we're gonna set up them here, but yeah, all events. Positions right here. Okay, this is if you enter a trade. So basically, let me enter a trade. So create new order, market, whatever. I'm just gonna show you. So you see right here, when you enter a position exactly right here, if you have the profit and loss shown, you will see how much profit and how much loss you would be in. Usually you can just remove it because that way you will not be again affected the psychology. You will not see your profit and your loss exactly on the chart, so your psychology will not get affected to it. So I consider, and it's better to just remove it. It's not important how much trade and how much money your trade is making. Anyway, you will be able to see everything below exactly right here. So seeing it on the chart is just affecting your psychology. This is the reverse button if you want to reverse the trade from long to short, so from bullish to bearish. Basically as well, long means bullish or a buy position, and short means a bearish position or a sell position. So this is if you just want, if for example this was a buy and you want to enter sell, straight away you can just reverse your position. We're not using it either, so it's not really important, so you can just remove it if you don't want. The orders, this is if for example I place a buy limit or a sell limit. So this is the buy limits and sell limits that we saw earlier. Basically I consider this is really important as we use mostly sell and buy limits, so this needs to be placed. The bracket profits and loss, this is for, again, if you want to see what's going on. I don't like it, again, for the psychology, so you can just remove it. And the execution, this is just to show you where you enter the trade and where you close the trade. But when you have multiple trades open and closed, you will just have a lot of these little arrows exactly right here, you see, showing up a little bit everywhere on the chart, and it's not really aesthetically pleasing and it's not clean. So I usually don't have it. If you have the labels, it's even worse. As you can see too much details, and it's just gonna be too much after trading a little bit on that same chart. So I just remove everything, and basically that's pretty much it. Those are other things. So extending price to see where your order is, you know, instead of having this line, you have this huge line. It's ugly, I don't like it. And this, honestly, it's, if you do a screenshot it will appear too, but it's not really necessary. Then alerts. The alerts, it's really important basically because we're gonna place alerts, so something like this, you know. So when for example a price go into this specific level, it will ring you an alert. So basically you need the alerts to be on and everything on exactly right here. So we're gonna talk about alerts later on, but they are important. So yeah, and alerts, everything on. And events right here, if you have if you want, you can keep them, but again, it's not necessary. It's just really to help you for the sessions or things like that that we saw earlier. But it's not really important, basically. Yeah, it's just showing you the sessions and what's going on, but you don't need that. And honestly, you don't really need anything right here. Like right here, it's just some events, some news events, if I'm not mistaken. I honestly never used it. So yeah, not important, to be honest. You can remove everything right here. And okay, let me just delete this too. Okay, perfect. So from here, basically you have your chart set up, right? Then let's see what's going on top. So on top right here, you have your pairs and your symbols that you're trading. If you click on it, you can search for any symbol. So for example, GP USD, and then you will see, be careful to be in all, because if you go in other things, you will not find anything you want. So for example, right here, when you search a symbol, you will have multiple options of the same pair. Right here, you have multiple brokers, because each broker have a different price feed. Okay, not every single broker has the same price. Yes, it's really similar, it's pretty much the same levels, but there's some pips difference. So it's important to choose a good chart, because as well, if for example I go on a chart like, I don't know, like Paperstone, you see that the candlestick closure are not exactly the same, and there is like gaps a little bit everywhere, and this, we don't like that. So the one we use is forex.com right here. You see as the candlesticks closing really well and opening at the same level that we talked to, and there is no gaps, weird gaps a little bit everywhere. So basically we don't want that. So yeah, you can select everything. Be sure to select forex.com right here and not anything else, because again, you will not have the same price feed as us, and we don't like it. And basically, even if your own broker is not forex.com, you still analyze the chart on forex.com charts, because they have the cleanest chart possible. And even if your own broker will not be forex.com, you don't care, because you will still analyze on forex.com chart, but then open your trades in your broker. So yeah, then you have the plus button exactly right here if you want to compare a symbol. So for example, if I want to compare Euro USD to for example NZD USD, you will have the two charts superposed. So this is interesting to compare symbols. We don't usually do it, but it's gonna be important for the correlation later on. But right now, not important, it's just there. Then you have the time frames. Right here you have multiple time frames that I already set up. Those ones will not appear if, for example, you don't have anything in favorites. So you will only have this. So in this case, I'm on the 1 hour time frame, and if I change, it will just change for the time frame. We're gonna use a lot of different time frames, so to help this process go faster, we can put some time frames in favorites. We're gonna use mostly the daily, so you can just copy paste what I'm doing. So place the daily in favorites, the 4 hour, the 1 hour, the 15 minute, the 5 minutes, and the 1 minute in favorites. So basically all of those time frames exactly right here, and then you don't need anything else. You can just keep those basically major time frames exactly right here. Then you have the candlestick and basically how the chart can appear. So if you change it, it will appear, it will be modified, as you can see. We do all our analysis with candles, so you need to select candles, but if you want lines or anything else, you can. But basically, we don't use anything else. We just use candles. You can play it if you want to see what it's doing, but we use candles. Then it's the indicators. Like I said, remember in the previous video about indicators, they are here. This is if you want to have templates. Basically, I don't have any templates, so it's not important. Here, if it's you want to add an alert. So basically, this is, we're gonna see it later on, but yeah, you can add alerts to get notified when price hits a certain level. Here's the button replay. Okay, this button, if you don't have a subscription, you will not be able to use it. It will be important later on for backtesting, but for now it's not important. Like, this just allows you to go back in time, you know, and hide what's gonna happen after. But basically for now you don't need it. Okay, you don't need this button for now. If you want to backtest later on, it will be important, but for now it's not important, don't worry. But the button replay is just making yourself go back in time. And basically right here have go back. So if for example I draw and I don't want, I can go back, and if I want to place it back, you know, it's basic buttons. And right here, okay, this will not appear. Okay, this will not appear. This is basically the favorites, like for the time frames, but for the tools right here. So let's go on the left. Right here you have all the different tools that you can use, right? And it will be important to select the tools that I have right here. Maybe you don't need all of it. It's depending of what do you want to do and what you're gonna use. But basically the major tools, let's start first with this one. This is basically just a cross. This is just to move the chart around. You can have a dot if you want, but I like to have a cross. That's just, you can choose whatever you want. You can have an arrow or whatever, but I like the cross right here. Then right here, this is the lines. The lines, the one that we're gonna use the most is the trend line, exactly right here. So it's the line to, you know, do this stuff like this. So we're gonna use the trend line, so you can just click and add it in favorites and it will appear right here. Then you're gonna have the other stuff that we don't use, so you don't need it. Right here you will have the Fibonacci. The Fibonacci is a tool that we use. We just need the basic Fibonacci retracement. We don't need anything else, so don't worry about that. Just take the basic Fibonacci retracement and right here. The patterns, we don't use them at all, so you don't need it. Right here have the projection tools, and we will need the long and the short position, so the buy position and the sell position. This is what will allow us to set our limits and predict what the trade will be doing, and see if, for example, we are losing our risk-to-reward ratios and all the necessary stuff that is going to tell us how the trade is performing. So we will need to have both long and short positions. By the way, this as well will appear. You can move it around if you want. So I place it right here so it's not disturbing me. And if you, for example, you want something that move around, don't hesitate to move them around. You just click and drag. Except for that, right here you don't have anything, you don't need anything else. Then for the brushes, this is really depending on what do you want to do and what do you need. I usually have the brush and the highlighter to show and mark the chart. The rectangle tool is one of the most important tools because we're gonna use it a lot to identify our zones. So the rectangle tool, really important, you need it. The pad, it's not necessary, you can have it if you want. It's as well to do like some projections and things like that. Then the text and the call out, it's more for me. If you want to say something or write something on the text or on the chart, you can. And except for that, I think that's pretty much it. Then you have some emojis if you want, but you don't need to add those in favorites. And yeah, right here you have the measure tool. So, you know, to measure pips, to measure times, you know, right here have how much time has passed and since this point and this point, the pips from this point to this point, and you know, how it changed, how much bars, whatever. So this is just the measurement tool. This is if you want to zoom in, you can. To be honest, I never used this tool at all in my life, but looks like it exists. Right here have the magnet. So basically the magnet is, for example, if I want to click on it right here, it's kind of magnetic and it just shows and kind of gets attracted to every wicks and every body closures without that I'm doing anything. You know, I'm just moving my hand, but it get attracted. You have as well the strong magnet. So this is even stronger than the previous one. So you see, it just does everything automatically. I don't use it because basically what you can do instead is press on control and it will activate the magnet, but temporary, you know. It will activate the magnet, but only temporary. Like that, you will not like be distracted by everything that is magnetic. You just press on control in your keyboard and it will get activated right here, as you can see when I press in control, you know. Then right here, if you don't want to move your drawings, you can just click on it, and then your drawings, if I'm not mistaken, stay in drawing mode. This just means that you will stay in drawing mode, but I usually don't get and don't care about that. This is one to lock your drawings. So if, for example, I draw something, I can lock it in, and now I will not be able to move my drawings, but yeah, it is. And then this is to hide your drawings, as you can see. This is to, I don't know, I never used it. And this is to remove all the drawings right here. So you can remove the drawings, the indicators, or both. So yeah, that's pretty much it. Then let's go right here in the bottom. So in the bottom, you have your timeline exactly right here with basically the time that every candle happened. You see, if I'm moving, it will show you the time zone and the date. Right here, have the pip size and basically the level of each pair, so where it is at the moment. Then right here in the bottom, you will have this. Okay, this is basically as well, it's the time frames. If you need more, it's basically the not the time frames but the intervals. Honestly, I never clicked on those, never, so I never used it, but is it there? It is there. Then right here, okay, let's start with the with this first thing. So stock screener is for stocks. Do we care about stocks? No, we don't. This means that we don't care about this first place. Buying editor, same thing. It's for coding and things like that. We don't need it, so remove that. Strategy tester is to test your strategy automatically, but again, we never used it, so we don't use it. Replay, it's the same tool that is on top exactly right here. So yeah, it's exactly the same. It's exactly the same thing. If I click on replay, it will get here, but we're gonna talk about the replay tools later on. And the one that we're gonna use is this paper trading, or if you don't have a paper trading account, you will have to connect a broker. So basically, paper trading is simulated trading, so it's without your real money. You just open it and you're gonna have access to like false money to trade with. We're gonna talk about it a little bit later on, but yeah, right here it will be your account balance, equity, and everything that we were talking about in the other videos. It will be shown exactly right here, as well with your history of trades, your account history, and this is just the trading journal, but we don't really need it either. And then you have the trade. The trading button is exactly this, so the one that we had on top to sell or buy, as you can see right here, with the market, limit or stop, like we saw earlier. And then right here as well, we're gonna talk about this later on. Right here on the right, you have all of these things, right? So the first one is the watch list, and basically the watch list, this is, you will need to create your own watch list. Because the ones that is the basic one is like with multiple stocks and multiple things that we don't trade. So to create a watch list, it's really easy, okay? First of all, you click on here. You know, I have as well my checklist, my watch list, and basically what you're gonna do, you going to create one. And how to create a watch list, you just go here and create a new list, and then for example you change it for, I don't know, tests. Okay, so then you click on save. You can take an emoji, I don't know, I never did it. Let's do an emoji, guys, for the funny haha of it. So okay, and then you click on save. So now you have your watch list exactly right here created. Now you need to add your symbols. So how to add symbols, you have this little plus, you click on it, and now you will search your symbols. So in this case, you can add Euro USD and all the symbols that I personally have. Then for example, if you added multiple symbols, so let me delete this one, it's not the right broker. So GBP USD, let's just add GBP PUSD. Let's just add some random symbols just so I can show you what's going on. So basically, imagine we have multiple symbols that you added. If I go in my other watch list, you see I have separators because again, it's gonna be less messy. So how to add one? It's actually really simple. You just click on this watch list and you click on add section. So now you will have different sections. You know, add sections. You have 2 sections, and now you can click right and rename the section. So for example, right here it will be forex. And right here, for example, it will be indices. And then you can just grab, hold your click and hold and drag. And then, for example, everything will be more organized. Then you will be able to close it, open it, close it, open it. And that's just going to be way more organized. So now I just suggest you, as you know how to do it. The other stuff right here, we never use it, so you don't need it. Basically, right here you can just copy paste what I have. You can even remove the change if you don't need it. Actually, we never use it, so it's really not important, to be honest. Like, really not important. But you can hold it for the fun if you want. You can add more things if you want, but we don't use anything. You need to copy paste what I have right here. Okay, so I have the major one. This is the one we trade the most. So just copy paste right here. Make sure to have everything with forex.com. So you can play pause to copy paste everything, create your sections. Then you will have the minor. So the minor pair is exactly right here as well. You can copy paste everything right here. And that's pretty much it. You have as well the commodities, but we don't really trade them much. So you can have it if you want. It's not really necessary. I never honestly touched this section. But yeah, that's pretty much it. So, and the ongoing part, this is the trades that are ongoing during the week right now. And the setups that already happened for your journaling. So yeah, that's basically it. And then you have every alert that you will place if you need, and anything right here, honestly, it's not important. You can explore if you want, but it's not important. Then right here you will have the layout. So for the charts, if you, for example, you want to have 2 different charts on 2 different pairs, you will be able to compare charts and things like that. Again, this is with the subscription. Usually without the subscription, you just have access to 1 chart. But honestly, it's not really important. Other things right here, honestly, this is the settings, and right here it's to put full screen. Honestly, we never use it. And right here you can take a screenshot. So when you click a screenshot, you can download the image exactly right here, or just copy the image. So when you copy the image, what is going to happen, it's going to copy the image, then you can paste it on Discord, or for example anywhere else. As well, to copy an image, the shortcut is Ctrl-Shift-S. So you click on Control, Shift, and S. So on your keyboard. So this is my keyboard. You don't see shit, but yeah, you click on Control, hold, you click on Shift, you hold, and you click on S, and it will do a screenshot. And yeah, that's pretty much it, guys, of everything you need to know about Tradingview. You have as well right here the comparison of what the pair did over the years and the performance, the seasonal, and all of this. But again, we don't really use it. This is just for extra confirmation or just extra information if you need, but we don't use it. That's why mine is all down to the downside. So yeah, guys, that's pretty much it. And yeah, last thing about Tradingview is how to set up templates. Okay, so it's gonna be a really long video about Tradingview, but it is really important to know how it works. So basically, later on we're gonna have like some templates that you can set up. I'm gonna talk about it a little bit later on, every time that we go over a subject to set up templates with you. But when you click on, for example, something, you can change the color of it for it to be pretty. You can have like a double click on it and make some text inside and things like that. And then, for example, when you like what you did, you can go here and click on these little dots and save a template. So for example, I have multiple templates right here. You don't need to know what it means, but we're gonna see it later on. But basically, for example, you can save a drawing template as, for example, let's do a test, okay? And then let's change this one color. Let's put it red, okay? And then I click here, and then I save my template as test. And then, yes, it exists, fine. So now, for example, if I go on another template, for example, I go here, you see it will be automatically changed with the one that I already put. And then if I go back here and test, it will go back to the template that I put. So this is actually really interesting and really important for later. But yeah, you will be able to set up templates with pretty much every tools that we just put in right here, our favorites. You will be able to add templates for pretty much everything. And last thing as well is right here, you will be able to change the colors of everything. So the long and the short position, I suggest you to change the colors for the same colors as your candlesticks. In my opinion, the stop color is the bearish one and the target color is the blue one. And as well, I suggest just to have the price label exactly right here. And you don't need to select anything else. So yeah, that's pretty much it. And you do the exact same thing for the opposite direction basically. And that's pretty much it, guys. So yeah, that's it for the tutorial on Tradingview. It was a long video, but it is really important to know how it works and everything that it's doing. So guys, welcome to this new chapter that will be about the trading psychology. So don't skip this chapter, please. This chapter is before the technical analysis. It's before learning the strategy. It's before anything else for a reason. It's because the trading psychology is one of the basic thing and one of the pillar of trading, and a lot of people are skipping the trading psychology, and then when it comes to trade in the live market, they are not used to having emotions. They are not used to not be able to following the rules because they cannot control their own selves. So first of all, what is trading psychology? Trading psychology is, like I said, one of the main thing in trading that a lot of people neglect, and it's basically all with the emotion gestion. So the gestion of your emotions, the management of your emotions. So if you don't manage your emotions in trading, you will not be profitable. And yes, you can have a very, very strong technical analysis. So you can have a very clean strategy and you can follow the rules if in theory, you know, but when it comes to trading on a live market, a lot of people cannot follow these rules, and it's really just because they cannot control their emotions. When it comes to trading, when you open a trade, right? First of all, if you can open this trade, you will be confronted to your own self. When it comes to trading, you are trading you against the market. No one is watching on you, and you are the only person who can decide which action you take, which trade you take. Do you buy, do you sell? You are the only single one person who can decide if this is a good trade and what you should do, how you can manage the trade. And all of this, it's rule based, but a lot of it comes from your mind. If your mind is not prepared to face challenges, to face emotions, your trading journey and your trading results in general will be really impacted. So what is trading psychology? It's everything that comes with trading. When you open a position, what do you feel inside of your own self? Do you feel happy? Do you feel excited? Do you feel scared? Do you feel like you're overthinking your entries? All of it, it's all in your head, right? So in this next chapter, we will just focus on understanding each single one of those emotions emotions, and then you can already have a preview of what you might feel when looking at the markets. And then if, for example, you're feeling some bad emotions while trading, you will be able to come back to this chapter in these videos to see how you can overcome these feelings and then become a better trader. So guys, don't skip this module. Listen to it very, very carefully and take notes. Maybe you will not understand everything that I'm talking about in this module because you didn't experience it yet, but when it comes to trading, after you learn the strategy and when you will practice to trade on your own, I promise you will experience some kind of emotions, and this chapter is just to prepare you to it. Right? So guys, let's dive into this chapter of trading psychology. Why 95% of people that start trading are not profitable? I don't know if you already heard that statement, but a lot of people are talking that when you start trading, out of 100% who start trading, only 5% or even less will get profitable. And it's really a really basic concept, and again, it's all due to psychology, because at the beginning everyone sees trading as an escape. Like I said, everyone sees trading as it's a very nice way of investing your money and multiply your money by hundreds and multiple percents. But trading is not for everyone. I tell it and I will repeat it every single day. Trading is not for everyone. This is why, for example, if a member of my family asks me to learn or, for example, to teach them how to trade, and I know they're only attracted to this lifestyle because they see that I succeeded, but they don't have that type of personality that it takes to be a day trader. When it comes to be a day trader, you need to have a certain type of personality that even if it's hard, you need to push through. If, for example, you fail one exam, it's not meaning that you're not smart, but for example, if you just don't study or don't do your homeworks, of course you will fail that exam. And basically trading, for some people, they portray it like an easy way of get money, but easy doesn't exist in this world. Even less is specifically with trading. A lot of people are selling signals or preaching that trading is so easy. You click on buy and sell and people think, oh yeah, I can do that too. But no, that's why a lot of people at the beginning, when they realize that trading is not as easy as they thought, they give up. They just give up. Or for example, they push through, they try to learn, but they're not dedicated enough. So then they see that they don't have results. They're like, oh no, trading is not true. It's a scam or whatever. And this is why a lot of people are failing. First of all, out of these 100 people that start day trading, half of it already quit after only a few weeks because they're not dedicated enough. They see how much information, how much practice you need to get to a certain level. And yes, you can get profitable if you put the work. But why a lot of people are failing, it's because they don't put the work into trading. And then, for example, if we take the people who actually put in the work and try to learn the strategy, they understand that it's not that easy as it seems, and they push through this first phase that a lot of people already quit, then they hit a wall. First of all, they don't know where to start. They don't know which resources to use, because in trading, again, there is a lot of resources. There is a lot of people that try to teach it, but not everyone has like a good teaching style, or for example, not all resources are clean or clear to grasp, So then from this half of people who quit at the beginning, then you don't have the right resources to learn efficiently. And again, they just get confused and they get overwhelmed, and then they're like, there's too much stuff to learn. I tried to learn, but it just doesn't work out. And then, for example, even if they found a good strategy and they found resources, then it comes to applying the strategy, still doing your homework, practice the rules, back testing, all of these stuff. This is even more work. It's like you have a big tunnel, and more you go inside, more you go inside, more you go inside, it gets smaller and smaller, and less people can pass, because again, there is more stuff that is like discovered in trading. Like if I show you some old charts that I learned, it was so completely messy. I didn't know where to go. I didn't know where to start. But then when you find the right resources and you keep pushing through to learn, and you keep pushing through to basically ask questions to get better every single day, you will get past these people who just give up. And then when it comes to, for example, the 10 remaining percent that still stick to trading and push through these hard times of finding a strategy, finding a community, and just understanding that it will take a lot of hard work and dedication, then you need to master your psychology. Again, it all comes to psychology, because then if you know the strategy but you cannot master your psychology, you will not succeed. You will not be profitable. So after you pushed through the strategy, after you pushed through understanding the market, after you didn't give up, then it's the last step to be profitable. Like last step, it's the trading psychology that a lot of people cannot push through it, because again, it's them against themselves. That's why again, when you push through that psychology, okay, and then you get profitable, this is how you will be in the remaining 5% out of 100 people that tried day trading. That's why even if you go through all the course but you skip the psychology, you will be stuck in this remaining 10% of people who cannot believe in themselves, who cannot control their emotions, who cannot push through that last bit of a sprint in the marathon to be finally profitable. And this is why we're having a big module just to talk about the fact that you need to understand that yes, it will be hard, but with the right resources, you will be able to master that psychology, and you will be able to be in the 5% of traders that will be profitable. So like we understood, in trading, we can have multiple bad emotions, and another one of them is the fear of missing out, or FOMO. If you already heard of it, fear of missing out. So what it is and how to overcompensate that. So first of all, the fear of missing out is when you are fearing or you are afraid of missing a trade. And this happens, it's kind of related to the patience, because when you have fear of missing out, you actually chase trades. Pretty much the same thing as with patience. If you're not patient enough, you will chase trades. And if, for example, you have the fear of missing trades, you will as well chase trades. So, how to overcompensate the fact that you are not fearing of missing out trades? First of all, you need to understand that it's impossible that you will take all the trades in the market. But there is a good thing about it. And the good thing about it is that the market is never out of opportunities, right? Even if, for example, you didn't catch one trade, tomorrow, new day, another trade will come. Catch this one, catch the other one that tomorrow will give you, right? Don't chase the trade. And even if, for example, you miss a trade, right? It happens to everyone. Missing trades is part of the game. Trading is something we cannot predict. A trade can happen when you're not looking at the chart. A trade can happen when you're sleeping. A trade can happen everywhere and anywhere. Why? Because market is open 24 hours and 5 days, and you are not looking at the chart 24 hours per day. So it's normal to miss trades. Guys, don't have this fear of missing trades, because it's normal to miss trades. And the trades that you missed, what you can do, you can still collect data about it, right? You can still backtest the trade, right? And more you practice, yes, maybe you will not make the money from that trade, but it's still good practice. And then, for example, you can collect data. And with this collected data, for example, trades that you missed, you can see maybe they're happening pretty much every single time at the same date or at the same time. So maybe with this data collection, you can actually adjust your schedule to catch more trades. But it's actually really normal to catch trades or to not catch them. Like, for example, for me, I live in a time zone where I cannot trade during London session. And like we already learned, London session is one of the most too volatile sessions, again with New York session, right? So a lot of trades happen during London. And at the beginning, I was actually really sad about it, because I'm like, oh, I'm missing a lot of good opportunities. I could have made more money. This is the thing to hear right here. I could have made more money. This is something that is not helping you by saying things like I could have done, I could have caught, I could have made, because this is not projecting the future. This is talking about the past, and this is giving you a sense of guilt that you didn't catch this trade. So remove these words from your vocab. Remove the words from your vocabulary and use something like other words instead. Talk about the future. Talk, for example, yes, I know that trade happened and it was a good trade, but I will, future, not the past. I will try my best to collect as much data as I could, right? As I can, not could, I can collect as much data as I can. Like that, what happens? I will catch this trade for the next time, and the next time I will make that profit. Okay, so that way you're changing your mentality from I could, and then you will be guilty about that you didn't do it, then for the future that I will do my best to next time catch that trade. And again, more you understand that trading is impossible to catch all the trades, and if you are doing every single thing right and you are following your rules, you are trading at your hours, you are trading during your session, you need to be proud of yourself and you need to acknowledge that you're doing great, that trading is not something that you control, that market is not something that you can control, and market will move even with or without you. So when you understand that, this is when you will be more peaceful with yourself and you will understand, I will not be able to catch all the trades, but I have more data about the trades and I know my strategy works. So I will keep applying it every single time, and in the future, even if I miss trades, I will still be profitable. When it comes as well to trading, we have another concept that is revenge trading. So pretty much the same thing as being greedy, but not really. When it comes to trading, sometimes when you have multiple losses in a row, you would like to cover them back, right? You will want to recover the losses. So for example, you have one day that you have multiple losses in a row, some bad emotions will start to kick in, right? And you will feel the urge that you need to recover from these losses right now. You will start to be impatient. This is where revenge trading comes from. So revenge, like you want to revenge yourself from the fact that you just had a loss. So it's like someone punch you and you're like, no, I don't want to get punched. And you punch them back and they punched you again. So when it comes to revenge trading, it's really you're forcing the trades, you're forcing the setup because you're being impatient and you want to recover the losses. And this is really bad because again, when it comes to trading, same thing. when there is a trade, we take the trade if it's according to the plan. And most of the cases, when you get emotional, you don't follow the plan anymore. So revenge trading comes from the fact that you just had a stop loss, and then instead of following the plan and looking for the new opportunity, you will re-enter the trade because you're like, oh no, I get out, I need to get back in because now I believe it will push down. But who told you to get back in the trade? Was that your strategy? Was that in your checklist? No. So why are you back in the trade? Because it will most likely end up really, really badly. So if you have this urge of chasing back your losses, when you have losses, you need to stop. You need to calm down. So basically, for example, you had multiple losses in a row, or you had a loss and just you want to recover because you don't want to accept that you had a loss. You need to basically first understand that it's normal if you had a loss, because again, not all strategies and no strategies are 100% win rate. Then second of all, you need to ask yourself, was the trade that I take, so is the trade that I take was a good trade according to my strategy? Was it according to the checklist? Was it according to the trading plan? If yes, you write it down and you be grateful for the fact that you again follow the strategy. Then you can continue to look in the markets. If there is another opportunity, go for it if it's according to the strategy. If not, if you start feeling the urge of taking unnecessary trades that are not according to the strategy, you need to step back, okay? You don't trade anymore. You see, like, you have the urge of like looking for another trade and you're like, where's the other trade? I want to recover from my losses. You're like, oh no, stop. And you like realize, first thing you realize that you're having this type of feelings. And then you're like, okay, what you're gonna do, you're gonna close the computer, close your screen, go do something else. I don't care what you're doing. Go eat, go take a shower, go walk, go do like some sport. I don't know. We don't need to know. Basically, just distract yourself, because this anger that you didn't get a win will fade, right? But if you just put some fuel, on that anger and you keep looking at the charts, it will not disappear. That's why you really need to step back and forget about your loss. Maybe you will think about it and you'll be, no, I want to get back the loss. But again, more you're far away from the computer, less impulsive you will be and less impulsive your decisions will be. And at the beginning, it might be really hard, but this is the easiest way, basically the easiest way to avoid revenge trading. And another thing that you can do if you really have this urge of wanting to open a trade, like really, you can open a demo account that is not for practice. It's just a random demo account without any data, and you open your random trade there. You open your revenge trade on an account that will not be impactful on your real account results, right? So even if, for example, you open on this fake account a trade like that, this envy of just like, this feeling will be out because you will have opened your trade, but your real account will be safe from damage and you will calm down. So you open the trade and then you walk away. That way, this urge of opening a trade will be on an account without any consequences, and then you can distract yourself from doing something else. So use these techniques if you really want to revenge trading and you really don't know what to do and you feel uncontrollable. But yeah, use these techniques, and guys, don't worry, it's normal to lose, but if you do responsible decisions, overall you will be profitable. So guys, let's go now over our first lessons of technical analysis. So this module will be about market structure, and this first lesson will be about market trends and break of structures. So basically, we're gonna start at first with some basics, so with like some lines, examples like this, so it will be really easy to understand and follow. And in the next video, we're gonna go over a real chart and we're gonna analyze the break of structures on a real chart. So first of all, let's just start with really the basics about trading. So we already know that market moves never only to the upside like this. It always pushes up, then it retraces, pushes up, retrace, push up. So this is how the market moves. It always push up, then it gets a retracement or a pullback, then it push up, retracement, push up. Okay, this is as well when we are in a bullish market. So when we are actually pushing to the upside, we're looking for buys. Okay, so if for example we're pushing to the upside right here, we will follow this overall market trend and we will looking for buys. But we already as well know that, for example, right here, market, when it is in an uptrend, it's creating higher highs and higher lows. We already saw this a little bit earlier. So higher highs right here and higher lows, and it just continue and push to the upside. So each new high is a new higher high, and each new low is a new higher low, because basically each high is higher than the previous one and each low is lower. No, I'm sorry. Each high is higher than their previous one, and each low created is higher as well than the previous one. So as you can see right here, we're pushing to the upside. So this is when market pushes to the upside, we call this a bullish market trend, or we just calling it that we're bullish, right? So when it's the opposite, we are actually creating lower highs and lower lows. Lower highs, not higher low. Lower highs and lower lows. Lower high and lower low. So what this means is that basically every new low is lowest than the previous one, and every new high and is lowest than the previous one as well. So in this case, this is a bearish market structure, and here we're pushing to the downside. So in this case, we will be looking for sells. And basically, when market structure is pushing to the downside or to the upside, we have a last phase that is called a consolidation phase. This means that the market is not pushing to the upside or to the downside. Instead, it's just moving sideways. So this means that we're never actually creating any new low or new high. So as you can see, no longer new highs were created, and there's no new lows either. It's just ranging, pretty much bouncing between the same level. So in this case, when market doesn't create any new high or new low, and it's just kind of ranging between pretty much the same level, this is when we call it a consolidation phase or a ranging market. And basically, when market is ranging or is in a consolidation phase right here, we are usually not trading because the direction is not clear. Now, this is the basics of trading forex, okay? This is the basic of how market moves, okay? So what you're gonna see next is what we call a break of structure. So as you can see right here, every time price breaks a higher high right here and creates a new higher high, so it creates a new high, basically we are breaking to the previous high to create this new high, right? So right here, this break of the old high to create a new high is called a break of structure. So this means that a previous high or low was broken and we created a new high or low. So in this case, it's a new high. So this movement that broke structure right here and create a new high right here is what we call a break of structure. Exactly right here, it's exactly the same thing. We have this old high, and right here we create a new high. So this is as well right here a break of structure. And the opposite can happen as well. So if we do it on the other side, so something like this, when we break a low, so this lower lows, basically we are breaking the previous low to create a new low, you see? So now we're having break of structures right here, but now to the downside. As you can see, exactly the same scenario. You see on the top right here, we never have a break of structure to the upside because basically we never broke through the highs. You see the difference? Here we broke through the lows and created a new low, but we never broke through the highs. So this is not a break of structure. But for example, if price does something like this, you see, and now it's pushing to the upside. Now we are breaking through this high, and now we are having a break of structure indeed, exactly right here, because now this is your high and this is your low, and now this high has been broken and we created a new high, you see? So break of structures can be happening in both directions. They can be happening by following the trend or for a reversal. Some people call this break of structure when it's changing direction a change of character. In my strategy and just in my terminology, to simplify everything, I call everything a break of structure. So yes, if you already have some knowledge of SMC trading, for you this might be a change of character, but to simplify everything for me, a break of structure is always when you break a high or a low of your trading range that we're going to see in the next video. So basically this is how a break of structure is working, you see? So every time we break a high or a low, we have a break of structure. So from here as well, we need to understand the concepts of trading ranges. So yeah, I said we're gonna do it on another video, but actually it makes more sense to do it in this video. So a trading range, okay, let me just delete everything right here. So a trading range is where price is trading at the moment between a high and a low. So how to identify your trading range? It's actually quite simple. You actually just need to identify your new high and your new low that price just created. So as you can see right here, let me change color. We have exactly this trading range. And why we have exactly this trading range? Because the last break of structure happened right here, and the last break of structure created this new low and this new high, right? If we go back a little bit, this is your previous trading range. As you can see, this was the previous high and this was the previous low. But then we broke through the low and we create a break of structure. So now the new trading range will be between the new high and the new low. And basically, you will always adjust your trading range after a break of structure. So for example, let's do the opposite direction for fun. So now we have a bullish scenario. So right here we have our both break of structures right here, as you can see. Now let's identify our trading range. So basically at the beginning, when price was at this point right here, this was the first low where price started, and this was the first high created. Then price retraced. As you can see, we had a pullback and then we pushed back up. So now this is your new high. You know, after this higher high has been broken, we create a new high, and the new low of your trading range will be the low connected to the previous high that has been broken. So in this case, this is the new low. Same thing, we pushed down and then we pushed back up. We created a new high, and the new low of your new trading range will be the new low that was connected to the previous high that has been broken. So is this low right here. So this is the basics of trading ranges. I don't know, something is itching me, but whatever. So yeah, this is the basics of trading ranges. Now this is really, really simple, right? What happens if, for example, something like this happened, you know? So now you have way more things to do and way more things that is happening, right? So let's analyze what happened right here. So first, let's start from there. First of all, let's identify our highs and our lows, okay? Right here, we have this low, right? And we have this little spike that looks like it's basically mountains and dips, you know? So this is your little spike of the mountain. This is your little spike, you know? This is your little spike of the mountain, you know? So all of those are little spikes. So Your first spike was here, so your first high was here. Then we broke through the high and we created a new high exactly right here. So same thing, your low will be adjusted to the low that was connected to the previous high has been broken. So now this is the low. Okay, for now it's simple. This is what we learned. Now what's going on there? Right here, as you can see, we have all of this price action that is inside of the range. So what do I mean by that is that, as you can see right here, this is still the high and this is still the low of your trading range, right? So to break a high or a low, we actually need to break one of those highs or this low. So this is the high we need to break and this is the low we need to break for having a break of structure, right? So basically at this point exactly right here, you cannot consider this, or this a break of structure because this is some internal structure inside of your trading range. What does that mean? Is that basically we don't care about what's going on inside of your trading range. Nothing that is inside of your trading range we care about. This is internal structure, but when we're looking at the external structure, so what's going on the outside, this is still your high and this is still your low of your trading range. So this is not a break, but the break of structure will only appear only when we're gonna break through the overall high. So now this is a break of structure. And now let's identify our new high. So this is the new high created. And now right here you have multiple lows, right? So it's, oh, this is me. So let me just put this to the side. I just want to see if my camera was recording. So, okay, it's good. So right here we have this new high, right? And now where is the low we need to put? Basically, you have three lows. We have low number 1, 2, and 3. So now we need to identify, first of all, the low connected to the previous high has been broken. In this case, you can tell me, okay, but they're all kind of connected to this high because this is the movement that connects this high to all of those lows, right? But I need you to as well identify the lowest point in the previous trading range that was connected to the previous high. So in this case, the lowest low between these three ones, it's this one right here. So this is the new low that we're gonna place basically, because this is the lowest point in the previous trading range that is connected to the previous high that has been broken. A lot of people make the mistake of identifying this right here as you know, as your new low. But basically, this is not the lowest point inside of the previous trading range. This right here is the lowest point inside of your previous trading range. So this is the new low. Same thing to the upside exactly right here. This is your new high, the new low connected to the previous high. It's this low right here. Same thing right here, you know, this is the break of structure. This right here is not the break of structure because this is the overall high. So everything that is going on inside of this range of this high and this low, we don't care. Same thing right here. This is not a break of structure. Right here, it's not a break of structure. So we don't care about that. It's not outside of our range. It's inside of the range. So bam, this is a break of structure. Same thing. This is your new high. This is not the low because this is not the lowest point in the previous trading range. This is right here, the lowest point in the previous trading range. Okay, really, really important. And now what happens, for example, if we do something like this? Okay, now look what happens. We have this high and we have this low. So same thing, everything that is going on inside of your trading range. So in this case, for example, this movement right here, we don't care. So this is not a break of structure. This is not a break of structure. Right here, it's your break of structure. So if price did something like this, there's a lot of people who do the mistake of considering these two breaks a break of structure and changing their trading range to this new move. But no, this is not your trading range. Remember, this is the low you need to break. And until price never breaks this low, you still are in the same trading range. If then later on it breaks to the low, then yes, then this is now a break of structure right here. And when we have basically right here a change in the structure, what will happen is that you will keep your initial high, and now it's just the low that will move right here. So now this is your new trading range. And then same concept will apply if, for example, everything happens right here. We don't care. This is still your high and this is still the low of your trading range. We wait what's gonna happen when price break either to the low or the high of your actual trading range. And then right here, this is the break of structure. So now we have this new range low, and the high is the highest point in the previous trading range that was connected to the previous low that has been broken. So this is the high exactly right here. So this is really the basics about trading ranges and break of structures. And basically you need to really understand that we don't care what's going on internally. We don't care, right? This is not breaks of structure. This is nothing. We don't care about what's going on internally. We care about what's going on externally only. And that's it. And that's it. So that's pretty much it. This is really the basics. And then, for example, if price again decides to push a little bit up, then we have a break of structure to the upside, and you keep the low and you change the new high. So basically this is how it works. Okay, this is how the trading ranges and the break of structures, the basics are working. So that's pretty much it. So in the next video, we're just gonna see exactly the same thing, but on the real chart right here. Okay guys, so now let's go over a really important concept that we're gonna use a lot in our SMC strategy. So let's talk today about the Fibonacci retracement. So this tool exactly right here. And we're gonna talk about as well the discount zone, the premium zone, and the equilibrium. So first of all, the Fibonacci tool that is right here on top, you will find it on the left exactly right here. So you see right here have Fib retracement. You can just click right, and right here you have this Fib retracement. Don't hesitate to put it in favorites, so you will have it in your toolbar right here on top. Toolbar right here on top. So when you select the Fibonacci retracement, yours will be a little bit different than mine, because you will have a lot of right here things that are checked. But basically for our strategy, what do we need is only 3 levels. We only need the 1, the 0.5 and the 0, and we're gonna see just in a few seconds why we only need these levels. So basically when you're gonna take your Fibonacci tool, first of all, I really suggest you to click on it. Then how to activate it, you just click on the chart one time, you will have the Fibonacci, you drag it and you click another time, and bam, your Fibonacci tool is now set. How to modify the settings, you can just double click on it, or as well just click right and settings. So like that you can access this little chart. I mean, you know, you understand. So basically I really suggest you to remove everything except the 0, the 0.5 and the 1 level. If you want the exact same colors, this is what I have for the 0, this is what I have for the 0.5, so the red, and I have the white one for the level number 1. So basically this is, yeah, you can copy paste my settings if you want, you can have your own if you want. It doesn't really matter. So let's now understand what's going on with the Fibonacci level. So basically we will use the Fibonacci right here, the Fibonacci retracement, to measure a retracement. Okay, so remember we were talking about break of structures. So we know that every time price breaks a high or a low, right here we have a break of structure and we have a change in our trading range. So in this case, this is the new trading range. But you see this movement exactly right here, we called it a retracement or a pullback. And basically what we're gonna do with this Fibonacci tool, we're gonna measure the retracement. As you can see right here, price retraces, and with these little stats we will be able to measure how deep the retracement goes. So what do we need that? It's basically because when you take the Fibonacci, you will have multiple lines. So basically you have 3 lines, right? So everything that is situated above the 0.5, so between the 1 and the 0.5 right here, this is what we call the premium level. Premium. So premium right here. So this is what we call the premium zone, not level, but zone. It's more a zone. So this is the premium, and the opposite right here in the bottom right here. So below the 0.5 or the 50%, it's exactly the same thing. So below the 0.5 and the 1, this is what we call the discount. So what does that mean? Discount and premium. And why is it important to know the premium and the discount zones? Is because of one simple concept. So let's do a quick example. So imagine that I want to buy a phone. So I want to buy this particular phone that is mine in this case, but imagine I want to buy it, okay? I will buy this phone at the cheapest price possible, right? I will wait until this phone goes, for example, in discount. So then I will buy it cheaper than, for example, if it was at a regular price. So for example, when you want to buy something, no matter what it is, a phone, a pair of shoes, whatever you want to buy, I don't care, you will wait for it to be in discount, because basically you don't want to buy it expensive. When you want to buy something, you want to buy it cheap, right? So for example, if this is the price of your things you want to buy, so for example your phone, okay, and then it pushes up, and right now it costs, for example, $5. It's a really cheap phone. So imagine it costs $5 exactly right here, right? But you know that if you wait a little bit, your phone will go in discount and it will reach, for example, 50% off. So instead of buying right here for $5, you will buy it right here for $2.5. It's way better for you. You will save money, right? This is why as well in trading, we do the same thing. If, for example, the price is right here on top and we want to buy, we will not buy it at the most expensive price. We will wait for it to retrace and pull back into the discount zone right here, so the price will be less expensive, because again we want to buy again at the best price possible. So if, for example, we buy right here when it costs $5, but we know that later on it will pull back and reach a zone that is less expensive, why do we buy it right here, right? We want to buy at the least at the least expensive price possible. So in this case, we will wait for the price to retrace into the discount area for buying it at the cheapest price. Now, if we do the exact same thing, but in the opposite way, now imagine that I want to sell you this particular phone, okay? I want to sell it at the best price possible. I want to sell it for as much money as I can, right? I want to sell it really expensive because I want to make a profit, right? I will not sell it for cheap. So if, for example, the price value of my phone right now, it's right here for example, same thing. I want to sell it for example, I don't know, let's do the same example, $5, okay? But I know if I wait, I will be able to sell it right here for $10. Okay, this is the top, right? Basically, I will not sell it right here for $5. It doesn't make any sense. It's too cheap to sell something, right? Because I know in the future, if I just wait a little bit, price, what will it do? It will just come back up, and then the value of the thing I want to sell will be more expensive. This is why premium is for expensive. Discount is for cheap, and premium is for expensive. This is why, for example, if we want to sell something in trading, we will not sell it at the cheapest price possible. We will wait for the price to push back up, reach this zone right here, so this premium area. So right here we will sell it for 50% more than what we initially planned, right? This is why we are not selling when it's in the bottom, but we wait for enough big retracement until it reaches the premium area right here, and then we will be able to sell it at a way better price. This is what we need. And for example, more the retracement pushes up, the better the price is, so the better the selling opportunity will be. Same thing for example, the opposite direction. So more price pushes down, the cheapest it will be, so the best buy we will have. This is why more price retraces between the premium and discount. So for example, more it retraces and pushes back up, the best opportunity it is, because again, it's going to be less or more expensive. So in this case, for example, now that we understood how premium and discount is working, we have as well a zone that is the 50% that is exactly right here. So this zone right here at 50%, this is what we call equilibrium. We don't really use the equilibrium zone. It's just that you need to know that the 50% is in the middle between the discount and the premium. So this is where it's pretty much equal. So this is the equilibrium zone, but we don't really use it. I just say when I talk about the 50% or the 0.5, I just say 50% or 0.5, but some people say for this specific number equilibrium, but in my like terms, I just call this 0.5 or 50%. So now that we understood that this is expensive, this is cheap, what do we do with this? So this is when the trading ranges and the break of structures comes in. So for example, okay, we were pushing to the upside right here, right? So basically what happens is that every single time we break structure to the upside, exactly right here, right? And basically what happens is that we creating new trading ranges, right? So we have this previous trading range, let me change color. So for example, we have this range, then we had this range, and now we are in this range, right? But like I said, we need to measure the retracement before considering it a new range. But basically, this is why we're going to use the Fibonacci. So when you're going to use the Fibonacci, you're going to measure the range with it. So every single time a high or a low is created, so for example, we had this previous low and this high, you will take your Fibonacci from the bottom right here to the top right here, and you're going to extend, as you can see right here. So now you will be able to measure the retracement. So as you can see, price right here tapped into discount and then pushed up. Then we create a new range. Now this is the low, this is the high. Same thing, you're going to take your Fibonacci from the bottom, click, you drag it to the top, you extend, and now you will be able to measure this part right here. So the retracement. Same thing. Then we had another break to the upside, to the bottom, to the top, click, and bam. Then you will be able to see what price will do right here and measure this retracement. Same thing for the opposite direction. As you can see, if you do something like this, you will have every single time a break of structure. So for example, right here and right here. And then for example, you can measure the retracement with the Fibonacci like that, from the bottom to the top, extend. You see this is retracing into premium. And then from the bottom to the top, extend, and bam, now we can measure the new retracement that price will create. So this is how we use the Fibonacci. We use it to measure the retracements. Now let's talk about the fair value gaps. So this is a really important concept that we're gonna use a lot in our trading strategy. So basically it's as well a concept that a lot of people are using in SMC trading. It's like the basic concept. So basically it's really easy. So we're gonna see how to identify today a valid fair value gap. So fair value gap as well, you can write it FVG, so fair value gap. It's exactly an empty space in a consecutive 3 candlestick candle on the candle number 2. So let me show you and let me illustrate it right now. So first of all, let's create 3 small candles. So I made it green, but the color of the candle doesn't matter. If I could have put it blue as well, as we're using blue and the white candles, but the color of the candles basically doesn't matter. So I mean, I can change it for blue as we're using blue, so why not? So this is a bullish price action. As you can see, we're pushing to the upside. As you can see right here, bam, bam, bam. Okay, perfect. So as you can see right here, we have 3 consecutive candles, right? We have candle number 1 right here, candle number 2, and candle number 3. So a fair value gap will be an empty space situated on the candle number 2. So candle number 2, where it is, it's right here. And we will be looking for an empty space, okay, between the candle number 1 and the candle number 3. So on the candle number 2, between the wick or the body of the candle number 1 and the wick or the body of the candle number 3. In this case, the highest of them both is the wicks. So as you can see from this point, so from this wick to this wick, as you can see right here, we have an empty space under candle number 2. So what do I mean by empty space? I just mean that there is no price action exactly right here. As you can see, if I throw a ball right here, if I throw a ball, so imagine this is my beautiful ball right here, it will be able to pass freely right here because there is no walls. So if, for example, I throw a ball, my ball will be able to pass, as you can see, phew, phew, phew. But if, for example, I do something like this, now you see my ball doesn't pass. There is a wall. So when we have an empty space between the candle number 1 and the candle number 3 on the candle number 2, this empty space is called a fair value gap. Okay? Same thing, for example, if we have no wick and it's just a body closure, we still have an empty space right here. So same thing, if the body is right here, we throw a ball, we still have an empty space. But if, for example, we have something like this, now, as you can see, right here, you see, we don't have an empty space. We have instead walls. So now if I throw my ball, it will rebound. You see, there is no empty space. You see the difference? Right here. So let me show you. Empty space. You see, empty space right here. No empty space right here. So no fair value gap. You see? So same thing. Even if, for example, the empty space or slash the fair value gap is really, really small, but there is still one. So let me do something like this. So between the wick of the candle number 1 to right here, you see, even if the empty space is really small, so the fair value gap is really small, it's still a valid fair value gap because same thing, there is no price action inside of it right here. So we still have our fair value gap. Same thing if, for example, it's something like this. So now we don't have a wick right here, but we still have the body, we still have an empty space, so we still have a fair value gap. You see? So you just need to be looking for an empty space where there is no price action. As you can see, empty space right here. If we do something like this, we still have a really small empty space right here. You see? So we just need to have an empty space where there is no wicks or no body closures. If, for example, we have a bearish scenario, so let me just change this to the bearish candlesticks. Sorry about that. So let's see a bearish scenario now. So white and white. Okay, same thing. Now we're still looking at 3 consecutive candles between the candle number 1 and the candle number 3. Right here we have the candle number 2, and we will still be looking for an empty space between the bottom wick of the candle number 1 and the top wick of the candle number 3, And as you can see right here, we have an empty space, so we have a fair value gap. Same thing, if I have my ball right here and I want to throw the ball, it will pass because there is no walls. If, for example, we have something like this instead, you see, now there is walls and now there is no fair value gap. So now, as we don't have an empty space, we don't have a fair value gap, and now if I want to throw the ball, it will rebound because there's no empty space. That's it. You can have multiple variations as well, you know, no wicks, no body closures, from a body closure to a wick, whatever. But as you can see right here in this area, there is empty space that something can pass. And if I do this, the empty space is now chow bye. So we have, and we don't have a fair value gap. Here we have one, here we don't, here we have one, here we don't, here we have one, here we don't, here we have a small one, here we have one, here we don't. You see the difference? And again, a fair value gap is on 3 consecutive candles. So it needs to be 1, 2, 3. And the fair value gap is situated on the candle number 2. So same thing, if for example, I add another candle like this, okay, imagine, so something like this, now we have 4 candles. Same thing for the fair value gap, you will be looking at 3 of them and ignore the rest. So for example, right here, there is no fair value gap, you see, because for example, 1, 2, 3, no fair value gap here. But if you take 1, 2, 3, there is a fair value gap here. So as you can see, this is right here a valid fair value gap, but right here we don't have a valid fair value gap. So that's it, guys. That's really just that easy, you know. You just be looking at 3 consecutive candles. You look at the candle number 2 to see if there is an empty space between the wick or the body of the first and the third candle. Now that we know how to identify a valid fair value gap, let's now talk about how to identify a valid imbalance. Now, I want to tell something about these two concepts. So the fair value gap, we already understood how to identify it really easily between 3 consecutive candles. An imbalance, it's actually really similar, but it's not exactly the same. And according to some people, and depending on who you are, what you experience in SMC, you might have already heard that a fair value gap is the same thing as an imbalance. It's just 2 synonyms. But in my opinion and in my strategy and how I use them for my confluences, they're not the same. And yes, they are really similar. Like for example, the square, okay, and the rectangle, okay. Technically, in mathematics, if you don't know about it, you will learn about it today. So the square, exactly right here, can be as well considered a rectangle. So a square can be as well considered a rectangle. Why? It's because it has pretty much the same properties as a rectangle of having 4 sides exactly right here, as the square has 4 sides exactly right here. So basically they have the same properties, because again, a rectangle is just a shape with 4 sides, right? But a rectangle is not necessarily a square. And why? It's because a rectangle, for example, right here, you see these sides are longer than, for example, these sides right here. So this rectangle is not necessarily this square right here, you know, but this square have the same properties as the rectangle, as you can see, because basically it has as well 4 sides. It's exactly the same thing with the fair value gap and the imbalance. So a fair value gap, okay, can be as well considered as an imbalance. So a fair value gap can as well be considered an imbalance, okay, but the imbalance is not necessarily a fair value gap. So like this, it's good, it's equal, but like this, it's not necessarily equal, because how to identify an imbalance is a bit different on how to identify a fair value gap. It has pretty much the same properties, but only one thing differ, that is a fair value gap. It's between 3 consecutive candles, and an imbalance, we don't care about how much candles it is in between. Same thing as the square and the rectangle. The square can as well be a rectangle because it has the same properties of having 4 sides, right? But the rectangle is not necessarily a square because it can be longer right here than right here, okay? So let's see the difference. So now that we understood that a fair value gap is an imbalance, but an imbalance is not necessarily a fair value gap, let's see what I mean. So for example, we know that, for example, right here, let's place this blue and this blue too. And right here, let's create a little wick. So let's imagine that this is our candle, and we have, for example, another candle right here that is bullish, okay? And let's say that we have another candle right here. So we already know that between the candle number 1 and the candle number 2, the candle number 1 and the candle number 3, we have right here a fair value gap if there is an empty space, right? This is what we learned in the previous video. Now the imbalance, it's not necessarily between 3 consecutive candles, because if, for example, we have another candle now bearish doing something like this, now this candle, it's a bearish one, so it's white. Now right here we have the fair value gap, you see, but right here we have the imbalance. And you see, in these two cases we have an empty space, right? We have an empty space right here between this wick and this wick for the imbalance, and between this wick and this wick right here for the fair value gap. But the difference is that the fair value gap right here is starting to create a wall that before printing this candle, it was not there, right? This was a valid fair value gap between these 3 consecutive candles, but here we have a new candle that got generated, and then we're starting to create a wall for our fair value gap. We're starting to feel the fair value gap, as you can see. So now between there is now no 3 consecutive, but now it's 4 candles. Here we have the imbalance, as you can see, because again, now the fair value gap is starting to come together, so to close, if I could say it like that. So an imbalance is basically really similar. It's still an empty space between 2 wicks or body closures, we don't mind, but now without being consecutive, only with 3 candles, it can be more. So same thing, right here we have an imbalance, and if I do, for example, something like this, let's say, so something like that, right here as well we have an imbalance, really small imbalance, as you can see, but we still have an imbalance between this wick and this wick. We have an imbalance here, and if, for example, it does something like this, now we don't have any imbalance, as you can see, because here we created walls. You know, we cannot throw a ball. There is no longer any empty space on this candlestick wick right here. So right here there's no longer an imbalance, but right here there is an imbalance, and right here there is an imbalance, as you can see. Okay, so this is really, really important. And basically same thing for the imbalance. We don't care about the candlestick placement, like I already said, and it's just between a wick of 1 candle, and it needs to have an empty space connected to your body like this. So you see right here we still have an empty space. So same thing, for example, for the opposite direction. Let me just do this. So for example, let's say we are now having a bearish scenario. So same thing, a fair value gap is between 3 consecutive candles, so we have a fair value gap right here. But if I take this wick into consideration, now it becomes an imbalance. As you can see, fair value gap right here, imbalance right here. Do you see the difference between, this is not between 3 consecutive candles. Same thing, if I remove, for example, here like that, we still have an imbalance, as you can see, because even if there's no wick, so we still have an empty space that we can throw a ball inside of it right here. And same thing if we have another candle afterwards doing something like this, you know, as long as we still have an empty space, we still have an imbalance, as you can see right here. So yeah, this is really important. Right here as well, as you can see, we created at the same time a little fair value gap, because again, between 3 consecutive candles, and right here we have the imbalance. You see the difference? So yeah, that's pretty much it, how to differentiate a fair value gap and an imbalance. So now let's talk about what is a valid POI. So this is a picture of basically my free ebook that I created. So we're just gonna use this as a reference, and then I'm gonna re-explain it more complicated. I mean, not more complicated, but like with more details, and show you more examples on a real chart. But let's just go on this first. So let's see what it's written right here on top. So a POI is basically a point of interest. So it's a specific area on a price chart, so in price action, that traders focus on because it's a key spot where important price action could happen. What does that mean? Is that, for example, if we have a POI, for example, in this area right here, we are actually looking at it because something can happen in this area, so we can have a reaction from this POI. So it's actually important because something at this zone can happen. Okay. These points are important because they show where big players like banks or institutions are likely to have placed their orders and where price may react, so we can look for an entry opportunity. So it means that, for example, this zone, so this POI right here, big banks like hedge funds, institutions, etc. might have placed some buy limit orders right here, and like we already know, it's those big banks and institutions who are moving the market. So we want to place our limits and buys and sell whatever orders at the same places as they placed theirs. So this is what a POI is. And now how to identify basically a valid POI? It's really easy. So let me just take this. So first of all, if I zoom in right here, a POI is up to 3. So what does that mean? Is that it can be 1, 2, or 3, not more. Up to 3 maximum. Selling or buying candles, depending if you want to buy or sell, before a move that caused a fair value gap or an imbalance in price. So for example, as you can see right here, we have this POI right here. So let me just zoom in so you can see. So overall, we have a bullish market, right? So we're gonna be looking at the opposite color candle. So in this case, as you can see, we are having bullish candles are blue. So to spot the POI, we need to look at the opposite color candle. A POI cannot be the same color candle as the direction. So a POI right here cannot be a blue candle. As we're looking for a bullish POI, it needs to be the opposite color candle. So in this case, a white candle. And like we know, it can be up to 3 candles. So for example, right here we have 3 consecutive white candles, right? And they are connected to an imbalance that we just learned previously, as you can see right here, between this wick and this wick. So these 3 consecutive white candles are constituting a valid bullish POI, as you can see. So as well, when I say it's up to 3 candles, it needs to be 3 consecutive candles of the same color. If, for example, this candle in the middle would have been blue, it would have invalidated the 3 candlestick POI because it would have not been consecutive. But in this case, as all of the candles are white, it is 3 consecutive same color candles that are pushing to the downside and creating a POI. And a POI as well, it's taking these 3 candles, wicks included. So from this wick to this wick, you're gonna extend and create a box, as you can see, and this is what constitutes you a valid POY. And as you can see later on, this POY got mitigated, as you can see, and we got a nice little reaction from this exact POY. Right here, I said, okay, an important thing is that after the POY is mitigated, so got tapped in once, it's no longer valid for another tap. So since the moment that the POY is mitigated, it's over. The POY has been used, and you can no longer look for another trade opportunity at the same POY. Right here we have another example. So as you can see, we're still bullish, and right here we have only one candle that is white, and then right here it is connected to a fair value gap, as you can see, because now it's candle number 1, 2, and 3, so it's between 3 consecutive candles. Right here we take this opposite white candle as a whole, you extend the box, so the wick and the body of the candle, it's connected to a fair value gap, so this is as well a valid bullish POY. And by the way, the criteria right here for a valid POY, it needs to be connected to a fair value gap or an imbalance. It needs to be unmitigated. And the last criteria, it needs to be up or down at least the 50% of the Fibonacci. So it needs to be in the discount or premium if you're trading range, of your trading range. So yeah, this is the criteria of the POY. And now let's go to see a bearish scenario that is not in this picture, but let's go now see a bearish scenario on a real chart. So as you can see right here, okay, right here you see we have this bearish momentum, so now the POYs will be blue. Again, the opposite color candle of the momentum. So in this case right here we have this blue candle exactly right here. So this is a valid POY. And why? It's because as well it's connected exactly right here to a fair value gap, as you can see. So now this POY is a valid POY, and as well it's not mitigated. As you can see, we still never tapped into it, so it is a valid POY, as you can see. And as well, this POY right here, then we broke structure to the downside and we had this trading range, and as you can see it was in premium, so above the 50%, so again it is a valid POY. For example, right here, okay, we have another blue candlestick, right, that is as well connected to a fair value gap, right, exactly right here. But as you can see, the difference between this one and this one is that this one right here was not in premium. So this POY was not a valid POY, as you can see. Even if it reacted, whatever, it was still not a valid POY, okay? Now let's go look at other POYs. So for example, right here, okay, so for example, let's say in this area, we had this bullish break of structure right here. We had this range like that. And right here we have the opposite color candle. In this case it's blue. In this case it's white because blue are the bullish ones. So right here we have our valid POY, as you can see right here. And then price tapped into the POY right here. And from this moment it got no longer valid for the future. Let me see something like this. So for example here, okay, we have this bearish momentum, as you can see. So we will be looking for this POY. Okay, right here we have this, as you can see, as a POY that is connected to a fair value gap, right? But as you can see right here, remember that a POY can be up to 3 consecutive same color candles. And in this case, we do have another color candle that is blue. So we can include this candle now in our POY, and it's still connected now to an imbalance. So now it's still a valid POY, and it was unmitigated at the time that we identified it. And later on, price tapped into the POY right here. And for later, it's no longer valid until price tapped into this POY. And by the way, at this area where price will tap into our POY, this is where we're going to be looking for entries. Okay, so basically when we had an entry right here, you don't longer use a POY twice because it's already used. Okay, a POY is only valid once, basically. And yeah, so that's pretty much it. So we can practice to identifying more POYs together. So for example, this is a valid POY, as you can see, because again, this is the opposite color candle with connected to a fair value gap. Let's see a not valid POY. So, okay. For example, this right here, this is not a valid POY because yes, it is unmitigated. Yes, it is connected to a fair value gap, but it's not the opposite color candle. In this case, it's the same color candle as the momentum. Right here, this would have been a valid POY because here, this indeed is the opposite color candle. You see the difference? Here it's not, but here it is the opposite color candle. So this is a valid POY. Okay? If, for example, I do something like this, this is not a valid POY because again, it's not connected to any fair value gap. We have a fair value gap exactly right here, as you can see, but we have an empty space between the POY where it's ending and the fair value gap. As you can see, we have an empty space. They're not connected. These two boxes, basically, what do I mean by connected? They need to be glued together like this. If they're not glued together, and we have some random price action inside of it, it makes it invalid. But let's see right here, I can add 3 candles right into a POY, and now let's see what's interesting right here is that now we have an imbalance, as you can see, and now this imbalance creates that the POY is now valid. You see the difference? If I take only one candle, so if I take only one candle like that, it's not valid. But if I take the 3 consecutive candles, now it is valid because now we have an imbalance connected to the POY, as you can see right here. So now this is a valid POY. Okay. And let's see something right here. So right here we had as well a valid POY. We could have included more candles in this case too. Okay. Same thing right here, we have a 3 candlestick POY, so this is a valid POY, as you can see, and then we reacted. Same thing, we're connected to an imbalance, so it's perfect, you know, so this is a valid POY too. So something like this, okay, this is not a valid POY. And why? Same thing, because this is a bearish POY and the color of the candle is wrong, so it is not a valid POY. But in this case, if I do something like this, okay, now this is a valid POY because here we have the opposite color candle and we are as well connected to an imbalance exactly right here. If I take only one candle here, it would not be a valid POY because same problem as we had earlier, we are not connecting these 2 boxes. They need to be connected, and this wick that is in the middle of these 2 boxes are destroying the POY. If this, for example, would have been a bit longer, so something like this, then there would have been an imbalance, and then, for example, this would have been a valid POY. You see the difference? So yeah, that's pretty much it, guys. So make sure to look at the color of the candle, that they have a fair value gap or an imbalance connected to it. And if you want to use more than one candlestick, look at them to be consecutive and the same color. If, for example, we had I don't know, let's try to find an example of when it would have been invalidated. So, okay, for example, right here, you cannot consider, for example, this, like that, as a valid POY, because basically, you know, this candle is white, right? If this is a bearish POY, we need blue consecutive candles. And in this case, as this is a white one, you cannot be considering this as a valid POI because this candle is the wrong color. If this would have been blue, it would have been valid because then we had all our other confirmations with the imbalance, etc., connected to the POI. Okay, and same thing, for example, this would not be a valid POI because we just don't have any fair value gap connected to it. And yes, we do have a fair value gap here, but same thing, it's not connected, so it's not valid. Okay guys, so now let's talk about how to identify liquidity. So basically what we're gonna do is we're gonna see first of all a little line example like we always do, and then we're gonna see on a real chart. So basically, first things first, you need to identify that, for example, right here we are in a bullish trend. And first things first, you need to know that liquidity is situated at each highs and lows. So for example, right here we have a high, so there is liquidity sitting up there, there is a low right here, there is a high right here, there is a low right here. So basically at each highs and lows, there is some liquidity that will be created here. Wicks are included. So basically what it means is that every single time we have a high and low, there is some liquidity created. But afterwards, when for example a high or a low is broken or only swept with a wick like we saw earlier, the liquidity is removed. And what price is doing, price is actually chasing liquidity. So what this means is meaning that, for example, when there is liquidity and where there is liquidity, we can expect that sooner or later price will come back in that area to sweep the liquidity that was initially there and then continue in the initial direction. Because basically what price is looking for, price is looking to eat the liquidity. So for example, if we already know that liquidity is situated at each highs and lows, and when price comes back up and for example break the structure and sweep it, so basically what do I mean by sweep is just, for example, when a wick is closing above another wick, like for example right here, or for example, you know, right here a wick is closing above the wick, this is a sweep. And of course you can as well do it with wick to body closure, but basically wicks are included. So as you can see right here, this was a wick, and basically price never went to sweep the wick, so sweep the liquidity. But if for example we did that instead, in this case price would have been up and sweep this previous wick because this wick went higher than this one right here. So basically this is what price is looking to do. So when we have a sweep or just a break, the liquidity is now bye. There's no more liquidity there. Same thing, as you can see right here, price came back up and then swept the liquidity. So this one that was right here is no longer there. But let's see what happens in the bottom. As you can see in the bottom right here, there is never price action that came back in that area. We never went down to sweep these two liquidity that was generated at these lows, and this high that was created as a new high, same thing. There was nothing that came up right here to sweep this liquidity. So after these two breakup structures, we only have three liquidity zones or spots left. And basically, like we already know, later on price what we'll do, as right here for example there is a buy position right here, and the big banks and institutions created this large order of pushes up right here, what happens is that this low is available to liquidity. So then for example price will come back right here to sweep this liquidity, so remove the orders that was placed right here and then continue in the initial direction by sweeping the liquidity to the upside. So this is basically how it works. Price will continue every single time to be chasing the liquidity. Price is actually just wanted to eat the liquidity as much as possible. Now you will tell me, okay, but is everything and every highs and lows will be swept later or sooner? And the answer is no, not every single high and low will be swept. This is why for our strategy we will use liquidity as an extra confluence. Some people are only basing their strategy on liquidity, but we are gonna use it as an extra confluence. So even if for example there is no liquidity sweep, we can still look for a trade, but we need to know in our head that it might happen right? So if, for example, there is no liquidity sweep, we need to understand that it might happen, so we need to be careful. But it's true that not every single liquidity will be swept, okay? But just remember, at each highs and lows, there is some liquidity situated, okay? And basically as well, another thing is that the liquidity is situated at each highs and lows, right? But if, for example, I do something like this, okay, so as you can see right here, we are in a consolidation phase, right? So price is not moving up or down, it's just moving sideways. What do you see right here? Right, you see a lot of highs and lows. So you see like high, 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 and low, 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 low. So basically what it means that right here and right here, there is a ton of liquidity generated right here. So you can expect that sooner or later price will just do something like this. For example, push down, sweep all the liquidity that was generated in this area, and then later on push up and sweep again all the liquidity that was generated in this area. So what you can understand is that if, for example, when we have an uptrend, right, there is liquidity right here, but see the difference. If we have only one low, this is not a strong point of liquidity. This is a weak liquidity, basically, because we only have one low to sweep. But when, for example, there is multiple highs and multiple lows to sweep, the liquidity will be stronger. And this means that if, for example, more there is highs and lows in one particular area, or more there is an accumulation of liquidity zones, more chances they are that price will come back and sweep the liquidity, because more there is something, more price is attracted to it. So this is why more there is highs and more there is liquidity overall situated in one area, more price will most likely come back and sweep the liquidity. Same thing as well, for example, you know, there is a lot of people that are trading, for example, chart patterns. So if you're not familiar with chart patterns, we can just look at them basically together. Okay, this is pretty much similar to candlestick patterns, so chart patterns. So it's really similar to candlestick patterns. It's just some drawing, and basically people are assuming what price will do next according to those drawings. And I don't use chart patterns. This is basically really retail concepts and really like basic trading concepts. We are using something more structured, but basically there are chart patterns that look, for example, like this, you know, that price is creating trend lines, and when, for example, price breaks out of a trend line, we have a position, you know. Let me show something maybe more big. So for example, like this, you know, so we have multiple chart patterns. So when, for example, there is a double bottom, what happens is that price will bounce on this double bottom and people think that they will continue to push up. But let's say now this, okay, let's copy the image and let's place it in Tradingview. So this is our chart patterns that a lot of people are using. Let's see what's interesting with it. Let's see all the highs and the lows that are situated. So basically right here, okay, if we just take the basic one at this area, you see right here there is a low and then there is another low, right? So right here we have two lows and then we have a trend line that connects these two lows. What we just learned about liquidity is that there is liquidity at each lows that has not been swept yet. So what does it mean? It just means that right here there is a lot of liquidity that is situated, as you can see. And what as well confirms it is that, for example, you see this chart pattern, it says that the entry should be here and the stop loss should be around this area. And as you can see, what it is right here in this area, the liquidity, right? So what it will most likely do, it will just come back down to sweep this area before continuing to push up. And as there is a lot of people that are placing their stop losses right here, price will even like it more, because while sweeping the liquidity, it will sweep everyone that had their buy position right here. It will kick out every one of their trades and then continue in the initial direction. Same thing, for example, right here, double bottom. This is another thing that a lot of people are working with. Same thing, you see right here, there is two little buttons that are situated right here that are at the same level. So what we learned about that, we learned that price, when there is a lot of same level price action, there is a lot of liquidity situated, and right here it's even a double liquidity because there's two lows situated at the same area. So same thing, people will try to look for a buy right here because they think this is a rebound, and they place their stop loss right here. So what price will do, it will instead just come back down, sweep the liquidity before pushing everyone out and continuing in the initial direction. Same thing for the highs, like we know earlier. Same thing right here, you see, more buttons, more liquidity, and we're actually trading against these people. This is why institutions, you know, they want to trick everyone out before continuing in the initial direction. But this is why we are not gonna fall in the trap, and we are actually going to work against them, and we're gonna spot the liquidity, and we're gonna spot these patterns, okay? So we will not be trapped. So if I remove the chart pattern, like we saw, when we have, for example, a trend line like this, people will most likely look for buy positions when price tap the trend line right here, for example. But what we know, as we have a trend line right here, it just creates a lot of liquidity right here. So you know, price will come back down, sweep this trend line liquidity before continuing to push up, and we will not get fooled by that. Same thing, for example, if we have more a complicated price action now, okay? Let's do something like this. Okay, what you can see right here. First of all, you can see right here that we had a trend line liquidity pattern right here, right? This trend line then later on got swept because price, as you can see, pushed down to sweep the liquidity available right here. Like I said, not all liquidity will be swept. So for example, this low was swept, but this one not. But it was a trend line, basically it just swept everything. And then look what happened. Is that, as you can see right here, if I do this, price started to create a double bottom, as you can see right here. So this means that there was even more liquidity exactly situated right here. And then, for example, price, what it did, it came back down to sweep the liquidity right here before continuing in the initial direction. So if, for example, someone just saw that price came back and bounced right here and they wanted to enter as a buy position right here with their stop loss below here, they would have been swept, but none of us would have been swept because we know that right here there is a lot of chance that price will come back in this area to sweep us before continuing in the initial direction. And same thing at the highs right here, there was pretty much equal highs that price came back up and swept the liquidity before continuing in the initial direction, as you can see right here. So we are basically just looking where price is creating trend lines, where price is creating chart patterns, so we can work against people who are trading these chart patterns, and we as well working to trade among the big banks and the big institutions. So yeah, guys, when there is any chart patterns that you know on, if you see any highs or lows, just see that mostly likely we're gonna come back down or up to sweep those places and those highs and lows where price never went to sweep it yet, basically. So yeah, this is pretty much like we can see right here. And same thing, you know, right here we had an available liquidity spot. The price went just up and sweep. You know, so it's really just how to identify liquidity. Just try to, for example, do something like this and then see what's gonna happen. So basically what's going on. I don't know what was that. But yeah, for example, you just draw a random chart and then you see every highs and lows where price swept each one of them. So for example, right here price swept the low. For example, right here, you know, for example, you know, right here price is just sweeping the high. Same thing, for example, right here, sweeping the high. And then you can as well identify where there is still rest and liquidity at that moment. So for example, there is one right here, there is one right here, and then for example you can as well just create a trend line liquidity like that. So you see that right here price has created a trend line, so most likely price will come back down to sweep everything before continuing to push up. So yeah, guys, that was pretty much it about really the basics of liquidity. So what you need to understand is just that price is chasing every single highs and lows in the market, and price is chasing liquidity. It wants to eat the liquidity, and we are aware of that. So we are looking to avoid getting trapped by the liquidity that is created in the market, and we use this liquidity to intensify our confluences and to protect ourselves from other losses. So now let's dive into our risk management section. That is the most important thing in trading after psychology or whatever. It is the most important thing before you start to get profitable. If you don't have a good risk management, you will not be consistently profitable. You can maybe be lucky at the beginning, but if you don't have a set of rules and a good risk management, your capital can be completely blown and you might lose your money if you don't risk your money accordingly. So first of all, we already know that the first thing about risk management is the stop losses and the take profits. We already talked about it, but basically every single time you have a position, so for example, this is a buying position, and for example, let me go down right here, you can open as well a selling position. So basically, if you want to open a buy position right here, at this area where your stop loss is, this is a safety net for your position that if it doesn't go in your direction, you will get kicked out of the trade automatically. So first thing and first rule about risk management is to always use a stop loss, because you don't want your account to go in negative infinitely, because basically we already learned about margin and things like that. So basically if your account just continues to drop, you enter in this position and then you just continue to drop down, you will blow your account. You will lose all the money in your account. And don't tell yourself, don't think about, oh yeah, but it will come back up sooner or later, because sometimes it just doesn't come back. And if for example you put, for example, a lot of money in this buying position and you just hold it internally and it just continues to drop, your money is ciao bye. Instead, what we use is, this is the stop loss that I just said. And this is what we use and why we use a stop loss, because if, for example, instead of risking, for example, right here, 1% of your account, if, for example, your account goes in drawdown, and if, for example, your account hits stop loss, you lose 1% of it. Instead, in each one of 1%, you lose 1%. 2%, 3%, 4%, and then you just continue to lose without any stop loss. And instead of only losing 1% of your account, you lost 10% of your account. And trust me, building back that capital up, it's way harder than protected at any cost from the beginning. It's like in life, it's always better to prevent than after that to try to heal it, right? This is why we want to prevent it by using stop losses, okay? And for example, okay, it's always better to, for example, lose 10 trades and then lose 10%, for example, in a row, than to have one single position that you messed up and you lost all your capital, right? Because in one position, maybe you made a mistake, maybe the market conditions were not great or whatever. It just hit stop loss. It happens, right? But it's better to have this opportunity and then later on you had another opportunity and then later on you had another opportunity. You're actually splitting your risk between multiple opportunities than just having one big opportunity and then you go all in without any stop loss, right? So this is the first things first about risk management. Same thing if you want to look for a selling position, just in the opposite direction. So first things first, when you look at risk management, okay, you need to as well be really careful. And we have multiple percentage of accounts that we can risk. So basically, when we talk about risk management, when you look at entering positions, you are not longer gonna risk your account capital with money. You will calculate it by percentage of your account. So we are actually using a risk management for live accounts. Okay, so if you trade on the broker, we actually saying to use between 1% and 3% of your account per trades. So what does this mean is that every single time your account hits not your account, but your trade hits stop loss, you will lose between 1% of your account and 3% of your account. You can go as well less or more, but remember, more you use a bigger percentage of your account in each trade, the easiest it is to blow it and the easiest it is to lose your account, basically. So if, for example, you use 1% per trade, you have 100 trades that you can use with this 1% risk before your account is chow bye. But more you increase the risk, more you have the opportunity to lose your account faster. Basically, you're increasing your chances of losing your account faster because a bigger percentage of your account is getting chow bye and removed every single time. So this is why for beginners, we always say use a 1% risk on a live account, because 1%, it's fine. You have 100 trades to play with before blowing your account. And with the trading probabilities we have with the strategy, you will never blow your account that way, because it's almost impossible to lose 100 trades in a row with a winning strategy. This is why this is a really basic rule and a really basic amount to risk per trade if you want to protect your capital. Because again, if you don't use a great risk management, your account can be blown so easily. You may lose money so easily. And basically, if you don't use good risk management with small accounts, not small account, but small percentage sizes by every single time you enter a trade, you will just blow your account so easily. And this is why as well, a lot of people in the beginning of their trading, they're over leveraging their accounts and they're using, like, for example, $100 accounts, and they try to, for example, enter with a too big lot size that is not risking 1% of $100. It's actually risking 10%, 30% of their account every single time. And then whoops, in 5 trades you don't have an account anymore, and they think, oh my god, trading is a scam, but they just don't use good risk management. And this is why as well in trading we actually prefer having a bigger account sizes, because again, 1% on a bigger account size is, for example, this 1% is $1,000, but 1% on a $100 is only $1. So basically, it's always better to have a bigger account size to make more profit while still risking only a small percentage of your account. And this is why as well trade management is super important. And in the next videos, you're gonna see how you can calculate your lot size to have the exact stop loss for 1% of your account, and how you can as well, accordingly to your account size and accordingly to the pair you're trading, you will be able to manage your risk accordingly. So guys, now let's go over the basics of our strategy. We're gonna do it in modules, okay, and different videos. We're gonna see, like I showed you the checklist, we're gonna see the basic scenario, that is the A+ setup basically. Then you will have the contract trend setup and the internal structured trades, right? So we're gonna start with the really basic scenario exactly right here that we're gonna use pretty much most of the times. So first things first, okay, I'm gonna just write it and draw it right here on the chart, and then I'm gonna show it on a real chart later on in the next videos. So first of all, let's start with the checklist, okay? Let's start by seeing what it's written, and let's reproduce what it's written on the Tradingview chart. So let's do the long trade first, because again, it's the easiest one, and the short trades, it's exactly the same thing, but in the opposite direction. So First things first, you need the 4 hour that did a recent bullish break of structure. So let's go on Tradingview. So this means that the 4 hour needs to do a recent break of structure to the upside. So doing something like this, okay, it needs to do a recent break of structure to the upside, creating right here a trading range. This is the first things first. Of course, if while price broke structure to the upside right here, it created some inducement, it's even better. You know, if price creates some inducement, so you know, a small retracement, it's even better. So something, let's say something like this, okay, this is some inducement, right? So this is the first things first. You need to have a, first of all, a break of structure right here to the upside, creating this trading range. Okay, first things first. Then, okay, if you don't have a trading range, you don't continue to follow the steps. You first need a good trading range. So this is why you need a good break of structure first. Okay, then the checklist, what it says: price mitigate a 1 hour or 4 hour bullish POY and has done a 15-minute break of structure. So first of all, let's just talk about price mitigated POY. So after you identified your trading range that just got created exactly right here, you will need to find your valid POYs. So how do you find your valid POY? First of all, you're gonna set up your Fibonacci, right? Because we already know that a POY is valid when it retraced enough in the Fibonacci range. So in this case, this is the low and this is the high of your range, right? Let me just change this color so we're gonna see it better. Let's put it green. Okay, perfect. So you see right here, 4 hour range. So this is the green color. This is the 4 hour structure. It pushed up and now it's time to identify our POYs. So imagine you have, for example, a POY right here. That is a POY on the 4 hour. And you might have as well, for example, another POY right here. That is, let's say, on the 1 hour. So after identifying your trading range, your good break of structure, you set up your Fibonacci, you identify all the POYs that are in discount because you want to buy, right? So you need the POYs to be in the 0.5 and below. If your POY is here, it's not valid. Your POY here, it's not valid. It's not below the 0.5. So really important, your POYs needs to be in discount or premium, depending if you want to buy or sell. So this is pretty much it. We identified now our POYs. And the next thing is it has done, okay, a 15-minute break of structure after the mitigation. So what this means is that, for example, when you identified your POYs exactly right here, you need to wait for the 15 minutes, okay, the 15-minute structure to comes back down, right? Tap into the POY and then do a 15-minute break of structure. We already talked about as well the 15-minute structure, the 15-minute ranges, how to identify them. So make sure to use those rules, okay? You need just a 2 candlestick retracement minimum to consider it a valid retracement and then a break of structure. So if it does this, you can continue. If price on the 15-minute never breaks the structure, right? You see right here, we don't have a break of structure to the upside and instead just continue to the downside, you will wait. You don't enter the trade at this POY if you don't have the confirmation, right? This is what we saw on the fractality of the market structure. We need a confirmation to tell us that this overall time frame retracement right here is over, because without the confirmation, we don't know if it starts gonna like continue to the downside, you know, right here, or it will continue to the upside afterwards. We need a confirmation on the lower time frame, in this case the 15 minutes. So let's say that the first POY right here didn't have any break of structure, and then price is pushing to the downside exactly right here, but now it got a 15-minute break of structure. You see here we didn't have any break of structure because we never broke the high, but here we did broke this high, so we did break this high, so now we have a 15-minute break of structure. You following me? So now this POY is invalidated, Okay, this POI on the 1 hour is invalidated, and we as well got right here a liquidity sweep, so it's even better, as you can see right here, right? So after price mitigated a higher time frame POI that is in discount, that swept liquidity and done a 15-minute break of structure, we can continue. So right here it did a break of structure, so perfect right here. Now limit is set at the most extreme 1, 5 or 15-minute bullish POI. Take the most higher time frame possible, don't refine it, if not you might miss the trade. If there's no valid POI on these time frames, don't set a limit and wait for a new range and break of structure. So what all of those fancy words mean and signify. So first of all, after you create your 15-minute break of structure, you will basically do the exact same thing that you just did on the higher time frame, but now on the lower time frame. So first of all, you're gonna set up your Fibonacci again from the bottom to the top. Again, because again, a valid POI is inside premium or discount, even on lower time frames. After you identified your Fibonacci, as you can see from this low to this high, as this is right here your trading range, as you can see, you will identify all your valid POIs, okay, on 3 different time frames. You will start with the higher time frame of them all. Why? Again, it's because, as we already know, higher time frames hold more power than lower time frames, right? So of course you will try to identify your higher time frames POIs first, because they have more chance to react, right? Instead, for example, a 15-minute time frame right here have more chances to react than a 1 minute. Okay, that's why you're gonna start by identifying all your valid POIs on the 15-minute time frame first, because it's the highest one of them all. Let's imagine you have a 15-minute POI right here, and on the 15-minute there is nothing else. As you can see right here, okay, this POI, it's kind of in the middle of the range. There is still some price action that was left below and some price action that was left above. So we already know that a price can retrace anywhere when it comes to the 0.5 range, right? It can retrace just by tapping right here and push up. It can just go down and push up. But again, you have more places where price might retrace and react. So you will go on lower time frame to see if on these empty spaces there is still other POIs that you can identify and look for trades there. And basically at this moment you will wait for, and you will not wait, but you will try to find the most extreme POI. That's why it says right here, limit is set as the most extreme POI. What I mean by most extreme POI, I want the POI that is the highest or the lowest in your trading range. In this case, as you want to buy, it will be the lowest possible. So if, for example, I have a POI exactly right here, in the bottom of the range, for example, on the 5 minutes, this is the most extreme POI. The time frame doesn't matter, but the POI that is the lowest in this case in this trading range will be your extreme POI. So this is where we want to enter. Why? It's because this is where the risk to reward ratio is the best. As you can see, it's way better to enter right here than right here, right? The risk to reward will be way better if you enter at a lower price point than on a higher price point. So you actually want to enter at the most extreme POI possible, okay? So let's say right here you go on the 5 minute and there is a 5-minute POI right here that is the most extreme. Same thing, there is still some place where price might react, right? So you can go still, even if you identified already your extreme POI right here, you can still go on the 1 minute exactly right here to identify if you have maybe other POIs along the way. So let's say you have another 1 minute POI exactly right here. So sometimes you will have only one POI, sometimes you will have no POI, but basically in this step, your goal is to identify all valid POI possible in discounts, right, of your 15 minute range. And in this case, no matter how much POIs you have, it doesn't matter. So you can have 1, you can have 2, you can have 3, you can have 5, you can have 7, whatever. And the most important one is to identify the most extreme one. So after you identified all of those POYs, okay, what if you don't have any POY? So if you don't have any POY at this step right here, sometimes it happens. There's no POYs that are valid. First things first, you need to see, okay, if there is no valid POYs at all, what it means, it just means that you need to wait for a new trading range, and this is just a trap. When there's no POYs, this means it's a trap. So what can you do is, for example, wait for another break of structure. So you will see if price pushes down, creates a break to the downside, and then you will wait for another break of structure. So then you will have a new trading range to work with new price action. Okay, if then later on price never breaks structure to the upside again, by the way, right here, be careful, this is internal structure, don't get messed up. You know, so if price just continues to the downside, then the POY is invalidated, and that's it. Okay, so if you don't have any POYs in this initial range after the 15-minute break of structure, on the 5, 15, and 1, I don't go on the 2-minute, I don't go on the 3-minute, I just stay on the 15-minute, the 5-minute, and the 1-minute. That's it. Okay, so if you don't have any POYs on those time frames, you just wait. What you can do as well is to wait when price will push up, and if, for example, there is new POYs that will be created along the way, you can consider them. But yeah, usually you just wait for a new trading range. Okay, so now let's say that we identified our POYs, like I said previously, on the 15-minute right here. Let's imagine the 5-minute right here. And we had a 1-minute a little bit, I mean, I don't mind. Let's do it now here. I don't mind, and we don't care about where the POYs are situated. Anyway, it's exactly the same thing according to all time frames. The only thing that is important for your time frame is to take the most extreme POY possible on the higher time frame possible. So what I mean by that is that, for example, if you have a 15-minute POY, okay, exactly right here, and inside of the 15-minute POY, you have a smaller POY that is on the 1-minute. So you know they're one inside the other. You will prioritize always the higher time frame POY. We don't refine the POY inside of the higher time frame POY. Okay. If, for example, you know, this is a 15-minute and inside you have right here, I don't know, 1-minute, you take the 15-minute right here. Okay, if you have a 1-minute like that and inside you have a 15-minute, it's gonna be really, really rare. This almost never happens, but again, we don't refine, we just take the biggest POY of it all and where it actually starts, right? So there is the chance that price reacts right here, so you will take still the 1-minute even if you have a refinement on the 15 minutes, because basically why we are taking the higher time frame POYs, it's because we don't want to miss the trade. Because again, if price just pushes here and then reacts there and you just refined it, you will miss the trade, and you don't want that basically. Okay, that's why you will not refine your POYs and you will always prioritize the high time frame ones. If, for example, the only thing why you can maybe take a POY that is a bit below, it's if, for example, or like not below but refined, it's if, for example, you have a 15-minute here, but you still have, you know, right here a little bit of space, and inside the little bit of space there is a smaller POY that covers this space, then you can be refined. Then it can be refined. Why? It's because there is this empty space right here that is not covered by the 15-minute POY, as you can see right here. So this is the only reason why you can actually refine your POY and take the lower time frame right here, because again, the 15-minute is not the most extreme. In this case, the 1-minute is the most extreme, because as you can see, the 15-minute POY end here and the 1-minute covers the entire extreme POY range. So that's pretty much it about the exceptions when it comes to entries. Okay, so let's say we have something like this. So after we identified all the extreme POYs, right, and all the POYs possible, you need to set your limit at the most extreme one. Okay, so what you're gonna do, you're gonna identify your most extreme POY and you're gonna set up your limit exactly right here. Okay, your stop loss will be below the 15-minute range low. Okay, so in this case, below the 15-minute range low right here, and you're gonna add a little bit of pips. How much pips you add okay, how much pips you add, I need you to add at least your spreads, minimum your spreads, plus enough space to cover liquidity sweeps. I usually cover it by pretty much 1 centimeter, depending on how much, like how your screen is big, etc., etc. In my screen, what I'm looking at, I'm going on the 15-minute time frame, and I'm looking at pretty much 1 centimeter between the low of the 15-minute range and the stop loss. So you see right here, for me, this is pretty much 1 centimeter. So this how will be my stop loss. And for my entry, I will add as well my spreads. So I will be tagged in, and a little bit of pips, like 1 pip, just so in case that price wants to come back here and then push up. Sometimes it happens that it didn't tap the POI exactly, but if we add a little bit of pips, you can just still get in the trade earlier than tapping the POI. So it's just in case that price comes really, really close to the POI and then reacts before. But yeah, you add your spreads plus a little bit of pips. Your take profit will be at the take profit one will be at the 15-minute high. So in this case right here. But if your 15-minute high is really, really far away, you will just target a 103 restored ratio. This is just the safest option exactly right here. Okay. And your take profit final will be at the hourly high. Okay, so the hourly high, it's not the 4-hour POI, it's not the 4-hour, I'm sorry, not the 4-hour high right here. You will go on the 1-hour time frame, and usually there was gonna be like a 1-hour high along the way, like doing, you know, this is for example the 1-hour structure. It will do something like this, and you will just target this high right here. Okay, it's not the same thing as the 4-hour high. Don't target the 4-hour high, target the 1-hour high. Okay, so that's pretty much it for your entry. So like this, stop loss below, 103 restored ratio. If the restored ratio is really good, what you can do, you can just as well just target the 15-minute high or a 1-hour POI. For me, what I consider a really good restored ratio, it's 105 and more. If it's 105 and more, for me, it's a really good restored ratio. So yeah, that's pretty much it. Okay, so after you identified your extreme POI and you set up your limit with the stop loss and take profit like I just said, what happens with the other POIs that are not the most extreme one? Because like we saw, they might react, you know, it might push up here or push up here, you know. So this is the next thing on the checklist. So right here it says, limit this at the most extreme POI, blah, blah, take the most high time frame POI possible, don't refine it. If not, you might miss the trade. This is exactly what I just said. If there's no valid POIs, don't set a limit and wait for your new trading range. This is exactly what I just explained. Alerts set at other bullish POIs down at least the 50% of the fib, right? Where price might show a 1-minute break of structure. So we already identified the other POIs that are up or down, in this case down the 0.5. So what you're gonna do, basically you're gonna keep your limit open at the most extreme POI, and at this area gonna place alerts. Right here and right here, gonna place alerts, because if for example price, again with the fractality of the market structure, comes back down right here and then creates a break of structure to the upside on the 1 minute, this is an early confirmation that this POI is ready to take off before mitigating the most extreme POI. So we are waiting to see if when price mitigate one of those other POIs that are not the most extreme one, if price will create a break of structure or not, so we can wait and look for an earlier setup, an early entry opportunity before the most extreme one. If price never breaks structure to the upside, you know, so it does just something like this and continues to push down without never breaking structure, we don't take the trade. We are just waiting for the 1-minute break of structure at any other POIs that are not the most extreme one. So let's say, for example, okay, you have your alerts. Why you have your alert is because you need to get notified when one of those POIs are mitigated. So you will not be constantly looking at the chart when it happens, but you will have a notification, so then you can react if it happens. So let's say, for example, you go on a lower time frame and then the 1 minute it starts to do something like this and taps into the POI. Again, if it breaks structure, it's good. If it doesn't break structure and just continue to the downside, you wait for the next POI, okay? If it doesn't break structure, you don't enter here. Same thing as for the higher time frame. We're doing the same thing, but on a lower time frame now, basically. So let's imagine that this one on the 1 minute got completely destroyed, but right here on the 15 minute, we broke structure to the upside on the 1 minute, exactly right here. What happens, okay? So what happens is the next step right here. So alerts are set, and now we are here. If price reacts from another POI, okay, where the alert is set, you need to see a 1 minute break of structure before entering at the new most extreme lower time frame POI of the new 1 minute range. You only have one try. If this POI fails, then you wait for the extreme and that's it. There is no second try. So what it means is that when you have a break of structure to the upside exactly right here, okay, what you're going to do, place this limit to the side, and you're going to focus on what's going on in this new 1 minute range that just got created exactly right here. So you will now identify your new lower time frames POI in this 1 minute range. You will start by identifying your POIs on the 1 minute. Now, in this section, we don't care about the discount and premium. This is the only place where we don't care about the discount and premium, and we don't set the fib. It's only on the 1 minute that we don't care about that, okay? On the 15 minute we do, and on the high time frame we do. But right here, after the 1 minute break of structure, you don't need to set up your Fibonacci. It's completely fine. Even if you're having a POI right here, you can still enter. And the reason why is because the 1 minute time frame is so small that the difference in pips is pretty much insignificant. If, for example, right here you have a POI or right here have a POI, okay? So you're going to identify your new 1 minute POI or lower time frame in general in this new 1 minute range. So let's say right here you have a 1 minute POI right here, and you have, imagine another 1 minute POI right here, okay? Now, when it comes to the lower time frame, you don't care about other POIs than the most extreme one. You don't care about this one. So in this step, you don't care about any other POIs that will be created, you know, right here, right here, right here. You don't mind. You're just gonna take the most extreme one and ignore the rest. That's it. Okay, you don't wait for other confirmation. You're just waiting for the most extreme POI. If, for example, on the 1 minute there is no extreme POI or there is no POI that is valid, you can go on the 5 minute and the 15 minute to see if on those other time frames there is a valid POI. Okay, but we're prioritizing the 1 minute. If, for example, on the 5 minute you have something like this, so a 5 minute POI a bit bigger than the 1 minute, you can use the same concept as in the bottom. You can just place your limit order a bit higher. So again, higher time frame has more chances to hold. But again, if, for example, you have a 5 minute here, this is not the most extreme one. This is the most extreme one. So in this case, you wouldn't care, if you understand what I mean. So if there is no valid POI, okay, in this new range on the 1 minute, you will do exactly the same thing as we did in the 15 minute range. So if there is no valid POI right here, on the 1 minute, on the 5 minute, on the 15 minute, you consider this a trap, okay, and you will just wait for another break of structure. If, for example, the POI still valid, so you know, so something like this, you can wait for another break of structure if price stays inside the POI. If the POI got invalidated, you know, so something like this, you will just wait for the extreme POI to be mitigated, and that's it. If, for example, you have one POI and on the one POI mitigation, you didn't have any valid, you know, break of structure. Let's imagine that this break of structure never happened, but you still have other POIs before the most extreme one. You do the exact same thing. When the POI is mitigated, you see if it creates a break of structure. If it does, then you start identifying your new 1 minute POIs in this new 1 minute range. And you do this until you have a valid POY in this new 1 minute range after the break of structure, or it reaches the extreme POY and you just enter without confirmation. When it comes to the extreme POY, you don't need the 1 minute break of structure confirmation. You can just straight away enter. The 1 minute break of structure confirmation, it's only for POYs that are not the most extreme one. The only reason why you would need a 1 minute break of structure at the most extreme POY, it's if you want to refine the entry and having a better risk-reward ratio. If the risk-reward ratio is already good, you don't need to refine anything. Because if you wait for a 1 minute break of structure at the most extreme POY, you have the chance that price just leaves without you, without never coming back into your entry. And we don't want that. The most extreme POY is the one that is the strongest, so has the best chance to react. So if you don't enter straight away, you will be more exposed to missing the trade. Okay? So let's go back to our POY right here. Let's imagine that it indeed created a break of structure exactly right here. Okay. So after the break of structure, this is the new low, this is the new high. Okay. And you identified, for example, your most extreme POY in this new 1 minute range. Okay. Let's see what happens next. Exactly right here. So price reacts from under POY, you need a 1 minute break of structure before entering at the new most extreme lower time frame POY. So it says that you need to enter at this extreme 1 minute POY of the new 1 minute range. So your limit that was placed right here, you will remove it and you will place it right here instead. Okay. Your take profit will be, first of all, let's do the stop loss. So the stop loss will be same thing, below the 1 minute low. Don't forget to add your spreads for, your spreads for your prop firm or live trading accounts. And same thing, you're gonna add a little bit more pips to avoid liquidity sweeps. On the 1 minute time frame, I usually as well use the 1 centimeter thing, like the 1 centimeter between this low and the stop loss. But sometimes, as the pips are really, really small, sometimes I need to add a bit more and just looking at the pip size. Okay. So, but it's pretty much right here. Just add enough pips to cover liquidity sweeps and your spreads. For your entry, same thing. You're gonna add 1 pip to your entry. If it's really, really, like the pip sizes are really, really big, you're not obligated to do it, but I really recommend to do so because sometimes really price don't tap you in. And as well, you need to add your spreads, don't forget to add your spreads. This is the most important. Then for the take profit one, as you can see at the 1 minute high, the risk-reward ratio is really bad. As you can see, it's only a 107 risk-reward ratio right here. So what happens? You will actually need to target a 103 risk-reward ratio if the risk-reward ratio is too bad. So 103 risk-reward ratio will be a take profit 1, and your take profit final, if the 15-minute high is already very good, so for example 105 and more, you can just target the 15-minute high as your take profit final. If you want, you can as well target the hourly high as your take profit final, but again, don't be too greedy. Okay, so yeah, that's pretty much it. And then you will just wait to see what the price is doing. First scenario, if price comes back down here and then reacts, perfect. At 103 risk-reward ratio, you will take some partials out. Okay, you will close 50% out, and you will place your stop loss to break even, and you will let the other remaining percentage run. You will continue and you will let it run again. Okay, and if, for example, the take profit right here, not the take profit, but the entry right here, doesn't work out and leaves without you, we're gonna see later on what to do in this case, but you will need to remove the entry. But if it continues to the downside and hits your stop loss, exactly right here, you will just wait for the most extreme POY to get hit. So if, for example, after a 1 minute break of structure and a first try, your trade didn't work out and then it didn't play out, okay, you're gonna remove all other POYs that are not the most extreme one, and you're gonna place back your extreme POY limit right here, and that's it. Okay, and that's it. You don't look for another break like right here and do this infinitely, because if they all loses, you will have just multiple losses in a row, and you don't want that. So if one loses, then you just wait for the most extreme POY, and that's it. Okay, that's it. So yeah, that's pretty much it. And another thing is, for example, if this first initial trade hits take profit, the most extreme POY limit is removed as well as the trade already happened. When the trade already happened before the most extreme POY, you remove this limit, okay, and you just move on to the next opportunity, because the trade already happened, the trade already played out, so there is no other opportunity right here. You have way more chances to get stopped out if you still keep your extreme POY limit. So guys, that's pretty much it. But same thing, for example, if now, let's say the most extreme POI right here, this doesn't happen, and you just continue to the downside, you know, when you get mitigated, you will have the same rules. So at the take profit number 1, that is 103 restored ratio, you can close your partials and place your stop loss to break even, and then keep your trade open until the final take profit. So yeah guys, that's pretty much it for the basic chart right here for the easy version. And in the next video, we're gonna see how to do exactly what we just did right here, but on a real chart. So I know there is a lot of information. I tried to simplify it as much as possible, but again, I suggest you to rewatch this video multiple times if, for example, you missed something or whatever, because it's really important. And take notes, and then when you're ready and you understood pretty much the basics, you can go now and watch the next video. So now that you know how to use the strategy as we learned about it, you need now to practice. So in the next modules, we will talk about how you can collect data, because again, like I've been repeating since the beginning of this trading course, you need to have data to have a profitable strategy, because trading is all based on probabilities. And basically, more you practice, more you have data to collect, more you know that your strategy is working over a long period of time, and this will help you a lot with your psychology and with your execution. And basically, how you can collect this data and practice is by having a trading plan and a trading journal. So right here I have my trading journal that you will be able to access. In the bottom I will put a link. So basically, this is our trading journal that we use with the community. We will go today over it, and we will as well talk about the trading plan, and basically we will analyze it, and I will show you how it works and things like that. But basically, if you don't have a trading plan or a trading journal, you will not be able to collect information in the most organized way possible, and you will not be able to analyze your mistakes. Because when you have a trading journal, journaling, you every single day, you write down what's going on. You write down what is your trades, what are your positions, how are you trading, what are you feeling, etc, etc. And then over a long period of time, you will be able to analyze your data, see if you have any mistakes, see if you can make your strategy better. See if, for example, you see that you have a lot of losses in one particular place, you will have this information with the data, because in trading we have so much trades ongoing, and basically if you don't have a trading journal, you will forget about the trades that happened. You will forget about your mistakes. You will just have a loss and skip it to the next trade. And then if you don't put down this information in a file, you will not be able to reanalyze it, because you will already have forgotten. For example, me, if I go back 2 weeks at a time in the back, I will forget what trade happened, because there's so much going on in the market every single day, and we trade in so much different pairs at the same time that you will not be able to memorize everything that happened and every mistake you did. So this is why having a trading journal with your trading journal right here, trading goals, etc., help you have this mechanical edge that you can analyze your mistakes and you can analyze what you can do better for the future. And as well, a trading plan with the risk you need to, so I'm going to click right here. So, with the setups, the highest probabilities, the okay probabilities, the low probabilities, you will as well be able to collect data and stay as much mechanical as possible if you follow the trading plan step by step. It's as well coming out with the checklist that you follow step by step, but then you add the trading plan as well that you follow step by step, and that way you know that your edge will be as mechanical and strict as possible. And this is what we want with trading. We are humans, we have emotions. So if, for example, we don't have a strict plan to follow, we will not be disciplined and we will not be executing the strategy as it should be. But with having a trading plan and a trading journal to analyze our mistakes and be able to execute the strategy perfectly every single time with step-by-step rules and plan, you will be able to become profitable way faster than someone that is neglecting having a trading plan and a trading journal. Because again, humans were making mistakes and we're learning from those mistakes. But if you forget what mistakes you did and what you did wrong or good, you will not be able to progress as fast if, for example, you analyzed your mistakes, right? So this is why it's super important to have a trading plan so you can be as mechanical as possible, and a trading journal so you can journal all your positions and your trades. That way you will be able to be as mechanical as possible and exclude your emotions from your trading. So now let's see how you can backtest on Tradingview. So you will see really not that complicated. It's really the basics. We already saw it a little bit together. So first things first, to backtest on Tradingview, you will need to have a Tradingview subscription. You cannot backtest on Tradingview without a subscription because, again, you will need this button that is the bar replay. And in the free version of Tradingview, unfortunately, there is no bar replay option. It's just blocked. So you will need to buy a subscription. The most basic one is the best. Again, you don't need more than that, to be honest. So yeah, when you're gonna buy your subscription, then you will be able to use this tool, that is the replay tool, that if you click on it, you will be able to go back in time and see the price action. And then, for example, right here, you can adjust the speed on how fast the price action is developing. And you will be able to play right here the price action, or just play candlestick by candlestick exactly right here. And this is where price it is right now. So as you can see, if you just go back and click here, this will just come and show you where the price is. So when you click on replay and you go back, for example, in time right here, you will be able as well to use this tool to select bar if you want to go back in time even more, okay? Because if you click on replay, you will just be able to exit. But if, for example, you want to go back in time a little bit more and you are already in the replay tool, this is the tool you need to go back a little bit more in time again. So this is how you can go back in time with Tradingview. So in Tradingview, you don't have like this automatic calculation of data with your win rate, your strategy, results, and like sessions, etc. That's why you will need to go actually on the trading journal that we already saw, and you will need to add your data manually. So as you can see, it will take more time. We will see in the next video another tool that is FX Replay that does this automatically for you. But if you cannot afford FX replay, or if, for example, you prefer backtesting on Tradingview, you need to use this data to journal your positions, okay? So first of all, you want to go back to a period of time that is really far away, so like 5 years, for example. Don't overdo it, because again, we need multiple pairs to backtest, but up to 3 to 5 years is good. Then you're gonna pick, first of all, a really easy pair. So for example, GBP USD or Euro USD, and gold or like NAS. Okay, first of all, focus on these major pairs. Then if you have time and you have more practice, you will be able to go on other major pairs. But first of all, let's do it on, for example, GBP USD. So you select GBP USD, for example, and like I said, you need to go back in time. Okay, so what we will do right here, it's already back in time at January 2020. So you start from a random point, like for example, January 2020. If you're not here, you just go replay and you go back in time. When you are in this random point, you will actually backtest. So how you will backtest? You will do it like you would do on a real market. You will start to apply the strategy. So you will play with your time frames. Like for example, you can start on the daily, see that the daily bias is overall bullish. So now you will say, okay, let me see if we have some buys. Bam, right here you can see we had a really aggressive push up. This is, by the way, the beginning of COVID. So let me just pass COVID real quick, because there will be an enormous gap that I know while COVID happened. Yeah, right here. This was during COVID, so maybe 2020 is not the best time to trade. Let me just play the price action a little bit. By the way, I need to close my eyes because I cannot, don't matter, because I don't know what happens next. But yeah, okay, September 2020 already is not as bad as, for example, March 2020. Let's start here, okay? So, daily bias, overall bullish, okay, overall bullish. So now we can go on the 4 hour. When you are on the 4 hour, you will identify your 4 hour range. So in this case, this is the last break of structure to the upside, exactly right here. So, break of structure. You will take your Fibonacci from the bottom to the top. You will identify then your POIs. In this case, we had this 4 hour POI, but as you can see, it got completely invalidated as this closed below. And then this POI is now invalid. So you can go as well on the 1 hour to see if we had a 1 hour POI. In this case, we did have a 1 hour POI exactly right here, as you can see. So in this case, I played the price action a little bit too fast, but I don't know what happens on the lower time frame. So this is the only reason why you can go back in time, okay? Because technically we had a 1 hour POI, it's just that I played it a bit too fast on the 4 hour, but I still don't know the outcome of this trade. So now we can go on the 15-minute and see if we have a 15-minute break of structure. This is the high we need to break. Here it pushed a little bit more down, so let's see if the POI is still valid. Yes, it's still valid as it closed inside on the 1 hour time frame. And let's see if we broke structure. So we indeed broke structure. So now we can identify our Fibonacci and identify our range. Then you can identify as well all your POIs, like for example this 15-minute one, and then see if we have a more extreme POI. On the 5-minute we have a more extreme POI exactly right here. Let's go as well on the 1 minute. So basically you're just trading the strategy and you're applying everything that you learned in your like watching of the course, of your viewing of the course. And then for example, you identified your POIs and you just continue to play the price action. Right here, don't play the price action too fast. You don't want to miss the trade. So for example, right here pushed up, you can adjust your limit, not your limit, but your order and your Fibonacci and identify new POIs. And as well, be careful of seeing if the trade is invalidated or not. So we reached this little 1 hour high exactly right here. Let me see if, for example, this 1 hour high was already a good risk-reward ratio. It was already a good risk to reward ratio, so basically this trade looks like we missed it. Yeah, we completely pushed up afterwards, and now looks like we're reacting from this 1 hour POI. So this trade, we missed it. So what we do, we remove the trade and we go and analyze the market as it would be. So we remove it, this trade, we missed it. Right here you can see that we're still bullish. This sell right here would be a counter trend, and this would be an internal, 1 hour range counter trend. You can try to catch it, but again, you need to adjust your risk accordingly. You know that this have more chance to lose. So let's go on the 15 minutes. You see right here, this 15-minute low is really far away. So if, for example, price never creates a new high, yeah, this 15-minute low is really far away. And we broke structure to the downside here, but as it's a counter trend and we already had pretty much the whole push down, it would be more risky to hold this selling position. As you can see, it got completely destroyed. I know it because I've been trading this strategy for a long time already, but right here, if for example you would take this sell, you would see that, oh, it got destroyed. Why? Maybe I did something wrong. Oh, the 15-minute low was really low. This move already happened without me. It was risky to enter here again. So you're just practicing and you just see what you did wrong. So you have a POI right here that reacted as well. You see that this POI reacted. Overall, we're bullish. This was maybe not a good trade, So basically, this is how you backtest, and all the results and all the data that you're doing, you are journaling it in this trading journal that we learned about it previously. And really don't be lazy, really journal the trade, journal the position. Right here as well in Tradingview, you can buy or sell with the lot size, but I honestly don't really like it because you cannot place pending orders. And we are just using pending orders mostly, so it's not the best. Just use this. Just use this to calculate your risk to reward ratio, etc. And afterwards, you can just, for example, according to your account size, you just do the small maths, about the risk to reward ratio, etc. So if you have, for example, a 100K account, so 100K account, and you want to risk 1%, it will be $1,000, as you can see. And then, for example, you made a 105. Let's say you made a 105 risk to reward ratio right here. Okay. If, for example, your trade worked, you will have made, for example, $500, right? And then you need to as well remove your partials, right? So it's small maths. For example, your partials was at 103 risk to reward ratio. So at 103 risk to reward ratio, you made how much money if you risked this? You follow me? You made basically 3,000, but it was divided by 2 because it was 50% off. So you actually banked, in this case, 1,050 at first, and left the remaining 1,050 in your trade. And when this one hit 105, the remaining $1,050, what happened is you multiply this basically by 5. No, you don't multiply. You don't multiply this by 5. You multiply the divided by 2 right here by 5, and this will make you a grand total of 2,050, and you multiply these two numbers together, and this will be your total of a complete $4,000 in total, because again you removed your partials and your lot size in between. But yeah, you see right here a lot of things you need to do. It starts to get a little bit annoying, a little bit complicated, so we actually have a way better way of backtesting that we're gonna see in the next video, that is FX replay. So guys, let's go today over what is prop firm trading and funded accounts. So if you are not new in trading, you might already have heard about prop firms and basically what are they doing. So a prop firm company or a simulated trading company, it's actually a company that will give you an account to trade on when you pass a challenge and you prove that you are a profitable trader. And they give you large account to trade on. That way, for example, you can use good risk management and make more profits. But these accounts, okay, to have access to them, like I said, you need to prove that you are a successful trader by passing a challenge. So look right here, I have this prop firm that I use, and in my opinion, it's the best. I won as well a trading award with them, and I flew to Prague. I met with their CEO, like I've talked to them in person, I've met their team. They're a really legit firm. They're not scammers. What I'm gonna say to you looks like too good to be true, but later on I'm going to explain why prop firms are actually a really hard thing to do and to acquire an account to trade with them, and it's way harder to acquire the account that it seems like. And basically a lot of people are failing with them, so don't think it's too good to be true, it's a scam or whatever. It's not, okay? So the prop firm right here, it's called For Traders. I'm gonna put as well a link in the description of this video so you can get 15% off if you want to buy a challenge with them. And basically they have really good rules, but let me just show you how it works. So basically you will have something like this, right? So it's trading accounts that you can purchase, and as you can see right here in the left, you have rules that you need to follow to pass this funded evaluation, right? You can choose from between different account sizes. Of course, more the account size is big, the more it will cost, as you can see right here. But let's start with a pretty small account size. Let's say, for example, 25K, so $25,000. So if you want to have a virtual capital of $25,000, you will need to basically pass a profit evaluation. So you will need to make a 9% profit target without never breaching a maximum drawdown. So as you can see right here, right now they have a promotion, but basically you have the maximum drawdown and the daily drawdown. So this is how much trades you can lose before your account is taken out, because yes, you can lose the funded account. So when you buy the funded account, you will need to make 8% on phase 1 and 5% on phase 2 without never losing more than 10% overall on your account and 5% per day. When you pass these funded evaluation while following all the rules, achieving your profit target without never breaching your maximum drawdown, you will receive an account to trade on. Like you can see right here, it says virtual capital, because yes, they will not give you live money. All of the prop firms are giving virtual money, so demo accounts basically. But all of the profits that you will make on this account, they will pay you a percentage on split. If they will pay you basically a profit split. So let's say, for example, you make 5K on this account, they will pay you 80% of that 5K. So basically, what is 80%? 4K or something like this. My maths in my head are so bad. So yeah, 4K exactly. So yeah, they will pay you $400. Now you will tell me, not 100, I'm sorry, $4,000. Now you will tell me, okay, but it's too good to be true. But basically, these prop firms, etc., they're not keeping the 20% other for themselves, because it's not real money, you know. Basically, why these prop firms exist is because a lot of people are purchasing the accounts before knowing how to pass them. And basically, when you purchase the account and you fail to respect the rules and you lose the account, you lose your account investment. You basically lose the money for what you purchased the account, right? And basically 89% of people are failing these funded accounts. So imagine 90% are buying like these funded accounts, while only 10%, even less, like 5%, achieve to make profit from it. So prop firms are not making their money by profit splits, they're making their money by people losing these accounts, okay? And then this is what you need to understand with prop firms. When you understand that it's hard to pass a funded account and a lot of people are losing these funded accounts, this is why in this next module, we will see how you cannot lose a funded account and how you can acquire a good account to trade on with a larger capital. Then, for example, if you make 1% of a 100K account, it's what, $1,000. So it's way better than, for example, if you try to trade on your small personal live account and only make $100 per month. Because again, they give you larger capital, and if you're profitable, it's not actually that hard to pass them. You just need to have good psychology, good trading, and good risk management. And in the next videos, I'm gonna talk more in details about how you can pass it, the specifications of the prop firms, and basically the trading conditions, how exactly they're working, and etc, etc. But just remember, in the large sphere of things, there are companies, like for example for traders, there are multiple prop firms. For traders, it's not the only one, but in my opinion it's the best. But yeah, there's multiple prop firms that offer something really similar with challenges. You buy the account, you pass the account, and then they give you an account to trade on it, basically. So guys, now let's see a little bit more about For Traders. So we're gonna see how you can purchase a challenge on For Traders, what their offer. We're gonna do it together, and I'm gonna show you as well how you can basically connect it to Trade Locker and things like that. So first of all, For Traders, like I said, they are a Czech-based company. I went to Prague to talk to them. I went to their trading gala. They're really clean. They pay out. They have more than $3 million in payouts. So guys, they're really good people, and they are safe. A lot of prop firms might seem a bit scammy, but For Traders are safe, and their trading conditions are as well really good. They're as well listed on Prop Firm Match. It's a website when you can confirm and compare prop firms. So basically they have 4.8 stars on Prop Firm Match, that it's just comparing other prop firms, and they're really good. So let me just let this load. So as you can see right here, 4.7 right now, but yeah, they have a lot of 4 and 5 stars, and they are really good, basically. So, okay, when it comes to For Traders, okay, this is the things that they're doing, but this is the most important. Okay, you have the 1-step that I don't recommend, and you have the 2-step and the 2-step pro. The difference between the 2-step pro and the 2-step is the fact that you have a daily pause and a daily profit cap. So basically you cannot make more than 2% per day, but you cannot lose because of a daily drawdown. You have a pause instead. So what it does is just that instead of losing your account after 3% loss per day, you will just be paused, your account will be paused, and you will be able to trade the next day. They have as well less rules for the 2-step pro. So again, for beginners, it's good if you don't care about the 2% profit cap right here. Like, they don't have the 30% margin rule, they don't have a daily drawdown, and you can as well trade news events, because again, on a normal 2-step evaluation, you can trade news events only during the challenge phase. When it comes to the funded phase, you need to be careful before high impact news, so you cannot trade news. With our strategy, we're not like trading news, you know, we're not trading news. We close the trades before news, but you know, we're not trading them, so it's not really applying to us. But you don't have to worry about that on the 2-step pro. Trading news are allowed, and there's no minimum trading days, so it's really good for beginners. But again, you have a profit daily cap right here, so anyway you need to make like 3 trading days to receive your 6% profit target, as you can see right here. So yeah, it's pretty much the same as, you know, you need minimum to have 3 trading days when you have 2% to have the profit target anyway. So the minimum trading days doesn't change anything, basically. So what happens right here, the difference between the normal 2-step and the 2-step pro is that the profit target exactly right here, it's only 6%, you know. So instead of having a 8% profit target, you have only like 6% profit target, still with a 10% maximum drawdown. So again, this is why it's really good for beginners, because basically you can right here have this 6% profit target way faster than if you go on a normal 2-step pro. Again, if you don't care about the daily profit cap. But if you use 0.5% risk, it's really more than enough to have a 2% gain per day, in my opinion. So this is the best in my opinion right here and right here. Then if you go down, they have multiple platforms that you can trade from. They don't offer MT5, but we already talked as well about Trade Locker that is way better than MT5 because they have a automatic trade assistant, a Tradingview chart, and it's just way better. They offer as well DX Trade or C Trader that we didn't talk about, but same thing, it's as well a nice little platform that you can use to trade, but I usually just recommend to everyone to use Trade Locker exactly right here. Okay, then of course they accept right here crypto payouts and Rise payouts directly with bank transfer, you know. Coming soon debit cards, and the average payouts it's 3 hours, and if you don't get paid within 48 hours, they pay you a 100% profit split. So basically they pay you way more than if you don't receive your, if you don't receive your payout fast enough. So you have this guarantee that you will get paid before not 24 but 48 hours right here. You have some reviews, etc. And then, for example, according to your account size, you can see how much money you can estimate with a percentage gain. In my opinion, a realistic gain per month by using good risk management would be like 4%. So you see, it's not that much. As you can see, it's not that much, but it's still a lot of money for people. And more you're gonna get comfortable, more you can buy multiple funded accounts and stack them up. So then, for example, you can make way more profit. Like, for example, if you have two 100K account, you will be making this per month. And if, for example, you have more and more, you will make way more percentage per month, and you will be able to bring back home a big amount per month. Then you have as well, basically with for traders, what it's really nice, they have a basic trading course right here, you see, created by their top trader, so created by Jan. He's a really good guy as well. I talked to him in Prague, and he knows what he's talking about, and it's included in any purchase of any challenge. So you have a free trading course. Of course, I don't know if you're gonna learn anything because you already have this one, but it's just another thing, you know. And that's pretty much it. They have as well a Discord that you can join with asking your questions, and their customer support are actually really good. And you can trade during hold the trade during the weekend without any fees, and just their trading conditions are really good. So yeah, this is why I really love for traders. And basically in the next video, I'm just gonna show you how you can buy a funded account with them and how you can log in into your Trade Locker, and then you will see together their trading conditions directly on Trade Locker. So hopefully by now you have a much better understanding on what to do in your trading and how to trade, and that you're now in the other half of the minority that are consistently profitable. So if you watched it that far, actually that tells me everything I need to know, because I guarantee that most people who clicked at this video already left by now. But you stayed, you gave your time, energy and focus, and honestly that puts you ahead of 95% of other people. This level of commitment is exactly what's separating the unprofitable traders to people who are actually gonna make it. So thank you for your time, thank you for choosing to learn from me, and I really hope that this video was powerful and valuable. And don't forget, if you want more resources and more support, I've put a completely free group so you will be finally a profitable trader in 2025. There you will get my full strategy, even more amazing insights, daily tips, and even more. So don't miss out, because I've put the link in the caption down below. So join it right now if you want to be even better, and I'll see you there.